On the back foot today, the euro just bouncing a little into the start of European trade, up by 0.2%, but still maintaining that 106 handle, which we saw delivered by the market post the ECB hike. Yes, it was a hike, but it was a dovish one. And then we've got S&P futures up by 0.2%. So just a suggestion, Tom, that as we go through this European equity session, there's still more to play for as we head into the weekend. Crucial take on consumer sentiment coming out of the US later on today.
And futures pointing to further gains across these equity markets. FTSE 100 futures putting up by 0.7%. It was a very strong session for the UK market yesterday, underpinned by basic resources. DAX futures pointing up by about 124 points, up 0.8%. And over in France, you're looking at gains of almost a full percentage point. Anna.
Yeah, you wonder if you see outperformance in London once again. We've got Brent crude at $94 a barrel now. That's the handle on Brent crude. We saw WTI go over $90 yesterday, over 91 then in today's session. Just below that, 90.83 I can see. So on the commodities column, we are pretty strong as well. So will that be a positive for London? Here's the start of the London trading day, up by 0.3%. Then on the FTSE 100, the Spanish IBEX up by 0.6%. We have been speaking to members of the Spanish government, and in fact will be speaking, later on today to the Spanish government about what they're doing on policy, but also reflecting on the ECB's decision whether there are any further hikes to come. The Spanish view so far seems to be no, there are no more hikes to come. The French CAC 40 up by 1%, so it's a strong picture coming through across European equities this morning. Here's the retracement a little bit in the euro from yesterday's losses, 106.62, then up just 0.2% as the dollar retreats, but it was a good day for the dollar yesterday. It was a bad day for the euro, and this is what we see on sovereign bonds. So we are selling some bonds with seeing those yields going a little higher, and as I mentioned, commodities a little firmer this morning. What does all of that add up to in terms of sectors then, Tom?
Well, you do have that policy clarity, it seems, coming at least from the ECB with that hike, but the expectation that maybe we are now in pause territory from the European Central Bank. We look ahead, of course, to the Fed next week, but the optimism is there, and it's really being reflected once again in basic resources and energy. Basic resources adding 1% after the gains of more than 4% yesterday. Energy also up by 0.5%. Pricing across copper, iron ore, oil, all higher, and that is feeding into those moves higher across those sectors. You have to wonder, though, when that becomes an inflationary challenge for these central banks. Tech is also performing relatively well, up 0.6%. The optimism coming through from the positive session over in ARM, the first trading day, of course, stateside for that US-listed but UK-based company. And a couple of other sectors that are standing out. Construction materials gaining 1.6%. You also have industrials adding 0.8%. Every major sector then in the session so far in the green with some conviction. Travel and leisure also posting gains of 1.3%. Across the benchmark, you're up by 0.7, Anna.
Okay, so a strong day of gains, and it seems that that data out of China, better data, is having an impact. As you point out, we've got consumer products doing well, some of those luxury names doing pretty well. We're also seeing those oil names doing well this morning, and energy up by 0.7% in terms of that sector. So US crude oil settled above $90 a barrel for the first time since November. We've seen Brent pop above 94 this morning. It's the latest milestone in a surge driven by output cuts from Saudi Arabia and Russia amid record global consumption. Let's get more on the oil sector and other things driving markets this morning. Eddie van der Veld joins us from the Bloomberg Markets Live team. And it's clear to think about the resurgent China, better data out of China and what that does to commodities, just adding to what was a drive higher in oil prices yesterday, even before we got this Chinese data.
Absolutely. I think commodities are really back in focus at the moment. They are a real driving force for the global economy, right? I think what you're seeing for oil is, of course, you know, you've had Russia and you've had Saudi cut back on production. production, and they've shown that they're willing to stand their ground, even if they give up some market share because they believe higher prices will help them. And higher prices will help them in the short term, at least. But I think the longer term picture is much more nuanced, because I think, as you push oil prices higher, you push demand from India, from China, from the US and from Europe much lower, and that ultimately becomes self-defeating. At the same time, you're pushing green investments, probably speeding up the decarbonization of the world economy, which many will cheer. I'm not sure that the Saudis and the Russians really had that in mind when they started cutting back production, though.
When it comes to these central banks then, and of course inflation and commodities is going to play into that, and you look at the divergence in terms of the economics of the US versus the Eurozone, and yet it seems that the central banks are ending up similar place in terms of the similar place, landing in a similar place. We maybe get a hawkish pause next week from Jay Powell when we had a dovish hike yesterday from the ECB. How are you thinking about the divergence or lack of divergence between the two central banks?
Yeah, and look, I do think that we are at that moment of divergence in the world economy, and I think that the US is a much easier monetary policy to set. They feel like they've got there. They feel like they can probably stand pat. Whether they are right, we will see. But that's definitely the view inside the central bank, is that they will want to stand pat. They've raised rates higher. They're now going to stay there for longer. The situation in Europe and then for the Bank of England is much more problematic, right? Because they still need. They're starting to fight stagflation here, right? We've talked about this all week, and we're getting those PMI numbers from Europe at the end of next week, and that will really tell us whether the situation has changed at all for Europe.
It's interesting what the read across from this week into next week at the Bank of England is. I noticed some of the home builders doing well today, and I was reading a note yesterday talking about whether what the ECB does will have an influence on the Bank of England, whether there are linkages there. Maybe that's the thinking in the markets around home builders. Let me ask you about, though, something else that's on the move this morning, and that's luxury names moving higher on the China data. So the China data doesn't stay in China. It has global reach, and certainly we see that around car makers here, but also around the luxury space.
Yeah, Anna, you're right. I mean, this is obviously a big story for Europe. If China picks up, luxury handbags and cars and all of that stuff will be sold over there. At the same time, that puts money back in European consumers' pockets, which then fuels China. So there's definitely a symbiotic relationships between these two big regions, and that will certainly help. But I do think that I'm going to look much less to the luxury sector about what's really happening and more to the commodities sector. I think the commodities sector will tell me more about what's happening there.
Okay, Eddie, thanks very much. Eddie van der Veld from Bloomberg's Markets Live team, joining us with all of the latest trading themes around central banks, around commodities, and around that data out of China. Let us take a look at some of the events that we're watching out for today. At 10:45 a.m. UK time, ECB President Christine Lagarde is due to speak at a news conference following the Eurogroup meeting in Spain. That'll be fascinating, the day after the moves we got from the ECB yesterday, the hike we got, but the dovish nature of it and the way the market interpreted it as the ECB's job being done for now. Now, at 11:30 a.m. London time, we'll get a Bank of Russia rate decision, the first scheduled rate decision after August's emergency 350 basis point hike. Bloomberg Economics sees the central bank keeping the rate unchanged at 12%. And turning to the US at 3 p.m. UK time, we will have results of the University of Michigan Consumer Sentiment Survey. And this is the big one for the markets, I suppose, Tom. I mean, we've had a lot of data already. We're perhaps needing a breather given the week we've got ahead of us next week. But in terms of data today, if you're going to pick, it's going to be around University of Michigan and what that's going to tell us about the consumer, because yesterday's retail reading was interesting. First print looked pretty strong, pretty bullish, pretty hot, but then the revisions were downwards.
Yeah, is that summer splurge starting to fade, particularly when you have that drawdown of household savings, the fact that you have to pay down student debt now for many people across the US, and of course, per gallon of gas, as they describe it, stateside, you're paying more, close to $4 now. And that ties into the commodity story that Eddie was just unpacking for us. So the inflationary impact and what that does in terms of the squeeze on households that don't have as much of a cash buffer. And of course, that is the view of Mark. He's seeing that recession by the end of this year. I still see that as quite a bold call, given that the data overall is still pointing to pretty decent resilience across the US, but the consumer is going to be central.
Yeah, he's focused on that pot of savings and the rate at which it declines. So we'll keep that under review. Coming up on the programme, the ECB hikes for a 10th straight time, but where does it go from here? We'll break down the decision and market reaction next. This is Bloomberg.
deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500. People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Wall Street is waking up. Europe is already trading. And starting Monday, Manus Cranny and Danny Berger will make sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, premiering Monday, only on Bloomberg.
This is Market Study. We're 11 minutes into the European trading session. You're seeing gains across the benchmark of 0.9%. The CAC is outperforming, adding 1.3%, getting a lift from luxury and the appetite coming through from China. Now, the ECB raised interest rates for the 10th consecutive time as President Christine Lagarde signaled a shift in gear in the current rate hiking cycle. The quarter-point rate hike sent the euro to its lowest level against the dollar in more than 5 months. Speaking at her press conference, Lagarde stressed the hike was not necessarily the central bank's last.
The focus is probably going to move a bit more to the duration, but it is not to say, because we can't say that now, that we are at peak.
All right, at this point, let's bring in Guy Foster, Chief Strategist at RBC Bruin Dolphin. Guy, good morning. Thanks for joining us on set. And as we talk about the ECB, a line crossing the terminal just a couple of minutes ago, ECB hawks, it seems, not going quietly, telling the FT that hikes are still possible in December. What is your take? Do you think they're in pause territory? Do you have now monetary policy clarity? And is that what's underpinning the upside that we're seeing for equities this morning?
You've got clarity in the sense that you're closer to a peak, but you've still got quite a lot of tension between the inflation data, which is not really rolling over in the way that people might want it to, and the economic data, which obviously does suggest you should be in sort of pause territory. I think the best term everyone uses, of course, data dependent, really, from this point, and that's always really the approach that policymakers tend to take after they've put in so many rate hikes consecutively.
And do you think the market action, the price action, is standing up to that analysis, that we are all data dependent? Because some of the data this week, you could argue, was a little bit on the hot side, but the markets, and with the previous market psychology, the markets could have jumped on that angle, but instead jumped on revisions to the downside, or decided to just look through certain elements of hot data. I'm thinking of US CPI, for example, as if the market psychology just really wants to believe in that soft landing and that the Fed isn't going to hike too much more from here.
Yeah, I mean, that's one way of putting it. I think another interpretation, maybe a generous one, is that the central banks seem to have a lot of credibility all of a sudden, perhaps surprisingly. I think that the euro's reaction really makes sense given the reduced forecasts for growth and longer term for inflation. So it's despite forecasting challenges that central banks have had, they seem very willing to take central bankers' word for how they perceive the outlook emerging. We've seen that across a whole load of different sort of central banking reactions. I know it's a bit of a tangent, but looking at Poland, the fact that that was treated as bond positive, in stark contrast, for example, to the reaction to Liz Truss and that sort of unorthodox kind of policy setting. Suddenly, a lot of bond markets and currency markets really do seem to believe that policymakers have got a degree of control over how these metrics develop.
So how is that changing the way that the clients at RBC Brewin Dolphin are looking to deploy capital? What are the conversations you're having? Where are you looking to find the upside at this point?
Well, I mean, within the bond market, I think really we still really like the short end. There's quite a lot of inversion. Inversion that was a sort of US phenomenon is now becoming a bit more widespread. I think with some of the things like, say, French 10-year bonds now don't have that degree of inversion. They trade a bit more like some of the other southern states, which seems like relatively good value for 10-year interest rate risk. But yeah, I mean, with the various other factors, which I know you've been talking about this morning, the auto workers' strikes, things like that, of course, there's still supply side concerns, the oil price. So I don't think you really want to be betting too heavily on interest rate declines over and above the ones that the market is already forecasting.
Are you thinking about a resurgence? I mean, we've seen a resurgence in some commodity prices already, haven't we, with oil at $94 on Brent? I mean, that does sometimes play well for the FTSE. Are you looking at that and linking the dots with where UK stocks go, at least at the multinational level?
Yeah, I mean, we tend to look really stock by stock, but I think certainly that is probably a factor that, well, it was clearly a factor that was really supportive for the UK yesterday, which was almost like it had a hint out of what China was going to report this morning. So yes, it's obviously it's a positive for the UK, and I think more broadly, it's a positive for markets in general. The big theme this year about the lack of breadth in the market, about those sort of 7 stocks holding everything up, is really beginning to sort of even out, which is what the market needed.
You talk about picking individual stocks, but let me just push you on this one. Would you buy the FTSE 100 at this point? The index, would it look attractive given the impulse coming through from China?
Yeah, I mean, I think for a lot of stocks and sectors within the FTSE 100, I think there has a lot of pessimism about China. And when you look at the data that's come out of China and the strange way it's interpreted, things like the purchasing managers indices, if you look across the world, there aren't very many regions or major economies. There's 2 major economies which have got an expanding service sector, and one of them is China, and yet you would not get that narrative from listening to a lot of investors and a lot of comment on the subject. And when you dig deep into what is driving China's weakness, a lot of it is down to things like the weakness in demand from Europe, rather than specifically the weakness in demand from China. I don't want to give the impression here that I'm a massive China bull. I'm just saying, objectively looking at the data, it's nowhere, it's not the kind of the whole thing's over narrative that is being peddled out.
Yeah, often our disappointment around China is just relative to very recent stronger performance, isn't it?
Of course, yes.
Guy, thank you very much. Thanks for joining us. Guy Foster, Chief Strategist at RBC Brewin Dolphin. Coming up on the programme, a blockbuster stock debut on the NASDAQ yesterday, details of ARM's mega IPO, and what's next for the chip designer. That's next. This is Bloomberg.
what do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Welcome back. This is Markets Today, 20 minutes into European trading, and you're seeing some pretty decent gains across European equities, a full 1 percentage point across the benchmark, and the standout coming through from the CAC current adding 1.4%, with consumer products and luxury soaring on the back of that stronger China data. To the tech sector, though, and ARM shares rocketing on their trading debut in New York yesterday. CEO Rene Haas told Bloomberg he remains bullish about the company's growth prospects.
We also have a very unique business model that gives us the ability to have a very, very good vision in the future in terms of when people use our products. So relative to our confidence in the outlook, we have a very, very high confidence that the growth rate that we have talked about will be sustained.
Okay, let's get more with Giulia Fioretti. Giulia, what does this 25% surge on ARM tell us then about the company's prospects, the appetite, and how well this IPO was pushed through?
So what it definitely tells us, Tom, is that it was priced pretty well. Obviously, it ensured that there was a nice first-day pop and that there was money left on the table for investors. Also, that investors bought into ARM's pitch that it can sustain this growth rate. It's expecting growth, sales growth of more than 20% next year, and this is expected to be boosted by the demand for AI and chips for data centers. So this is part of its strategy to pivot away from the smartphone market, which is slowing, and more into AI, which has obviously driven a massive tech rally this year. So obviously that powered the first day pop. Now whether it will continue remains to be seen from its sort of results as it in the coming years.
Julia, what does this mean for Masayoshi Son at SoftBank? Matt Levine had a really interesting piece, our colleague, yesterday, talking about how it plays to his advantage, the fact that this stock had a very big pop on day one, because he's someone with it's important for him to have good relationships with markets. What does it mean for him?
Well, it's certainly a vindication of sorts, because his track record with IPOs hasn't always been great. He was also backed sort of other troubled companies like WeWork. So the fact that he has successfully pulled off this IPO with a nice first day pop is a vindication of his investing prowess as well. Obviously, still the first day pop is nice, but then if the stock tends to fall afterwards, then that won't be seen as such a success. But it's certainly that good headline that he needed, and that good sort of track record to successfully sort of leave money on the table. And Bloomberg reported that he was the one who didn't want to price above the price range, despite there being enough demand for it.
Yeah, he was pushed to go 52, and he kept with $51, and it appears, as you say, to have paid off for now. Julia, does it open the door? Is this the catalyst that was needed for the capital markets, for more IPOs to come to market?
It certainly was one that everyone was watching, and it's while it might not open the floodgates, the fact that it's done well means that the market is open in a way. So there are companies which are meant to be pricing next week, such as Instacart and Klaviyo, and the fact that ARM has done well, that investors have made money off it, means that they're more likely to come into other IPOs, and also that a tech IPO can work. It's been quite obviously, despite the rally for IPOs, it's been a troubled time because valuations have come down so sharply from where they were in 2021. But the fact that ARM has done well and has sailed off into the public markets should definitely pave the way for others to follow.
Yeah, we'll see how that positive mood spreads then and infects other listings. Julia, thanks very much. Bloomberg's Julia Fioretti with the latest on the ARM IPO. Let's get a check on the individual stocks on the move. There are plenty of them. Lizzie Burden has a briefing. Lizzie.
Well, Anna, it's a pretty positive session here in Europe this morning, and among the biggest gainers are the luxury stocks. As expected, this is on that China eco data, industrial production and retail sales. Stan chart says we may have passed peak pessimism on China. So you can see them all up nearly 3%, Kering up 2.6%. And another beneficiary of this, of course, is also basic resources as a sector. The likes of Antofagasta, Rio Tinto this morning among the gainers, very exposed to China. Also, if we just flip over, Derwent London having a good session this morning. This is after Goldman upgraded it to buy. But if we look over to the losers now, one of the biggest losers, if not the biggest loser this morning, is H&M. Its third quarter sales missed estimates. You've also got Norwegian Air down in the red this morning, down 1.6%. This is because the Norwegian Competition Authority has said that a potential deal to take over Widerøe, another Norwegian airline, could impair competition, could lead to higher prices, and is going to need further analysis if that deal is to get over the line. Finally, Stellantis, as we expected, the spillover effect of those strikes at the big three automakers in Detroit. The first time in history it's happened simultaneously. So Stellantis down about 1% this morning. Anna.
Okay, Bloomberg's Lizzie Burden. I'll pick up from here. Thank you very much indeed. Colour matched with the previous board, at least, if not the last one, with the auto stocks there down on the back of that news. 150,000 workers, Anna, involved potentially in these strikes. And as Kriti has been pointing out to us, who's covered the auto sector for a long time, it really comes down to how long this strike goes on for, to what extent it's prolonged. But the demands are really ambitious from this new union boss. He's the first union boss to be directly elected, and previous ones, a couple of them, in jail for corruption.
Okay.
There's the union story as well.
There's a lot to watch there on the union story. On the GDP side of things, you know, we've got Bloomberg Economics out with an estimate. You know, the car industry makes up 3% of GDP, so depending on how long this stoppage goes on for, could have an impact on that GDP figure. We've seen strike action really taking a chunk out of UK GDP, so that's something we're certainly watching. Coming up on the programme, we dig into the impact of the auto strikes. This is Bloomberg.
Half of all American women in opposite-sex relationships now make the same or more than their husband. That's a record high. According to a new report by the Pew Research Center, a third of U.S. women are in egalitarian marriages, making roughly the same as their husbands, and another 15% of them are the breadwinners. Women with college degrees and no children, as well as Black women, are even more likely to make more or the same as their partners. But not everything is a bed of roses. Working wives still carry most of the weight of unpaid labor. Women in egalitarian marriages spend almost twice as much time taking care of the home or a loved one, while dedicating less time to leisure.
Women are continuing to go out in the formal labor market and contribute and are still bearing all of the load of responsibility that disproportionately falls on them in terms of family care.
During the pandemic, in the wake of school shutdowns, the height of the childcare crisis pushed nearly half of American women out of the labor force, a trend that's yet to be reversed.
Women are just really struggling to meet the care needs of their family, and at the same time are really, really leaning into the labor market. And I don't think we've seen this before in history, to be honest.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
This is Markets Today, 30 minutes into the European trading day. Here are your top stories. Stellantis drops as US auto workers strike at the big three car makers for the first time in history, setting up a showdown over wages and job security. European stocks broadly follow Asian stocks higher after better than expected economic data from China and more support measures from the central bank. Plus, ARM soars 25% in its trading debut after raising $4.9 billion in the year's biggest IPO to date, delivering a boost for SoftBank and its founder, Masayoshi Son. Tom, then European equity markets pretty positive as we close out this week, taking all of the data in our stride, it seems, in terms of sentiment.
Yeah, some pretty convincing gains coming through for European equities and a trio of positive factors coming through from China. The RRR cut yesterday, increased liquidity pumped into their markets from the PBOC today, and then that data coming in stronger for retail sales, so important, and industrial production as well. The retail data stateside revised lower. That was seen as a positive in those looking for a soft landing, aligning with the Fed's policy. There's a warning from Ven Ram, though, from our MLive team when it comes to how to interpret the hike that came through from the ECB yesterday. He says markets, well, it's folly to think and to assume that the ECB is done and dusted. The warning there from MLive's Ven Ram. But still, equity markets getting 0.7% on the back of that China data. Luxury getting a lift. Tech is a little bit soggy, but we'll break down the sector shortly. DAX getting 138 points, getting 0.9%. And here in the UK, the FTSE 100, which, by the way, in the last month has outperformed some of the other major indexes, despite year-to-date being slightly lower. 7,726. Is this the turn now for the FTSE 100 on the back of that better China data and, of course, depressed valuations? Getting 0.7% and adding 53 points. Let's split the screen then and see how things are shaking out across these sectors. It was basic resources that really stormed to the front yesterday, gaining a little over 4%. Currently, you're seeing travel and leisure fairly high up the list in terms of the sectors that are in the green, adding 1.3%. Energy is also gaining 0.4%. There's the basic resources gain again today on the back of higher copper prices, oil prices and iron ore prices, oil lifting energy, copper and iron ore lifting basic resources. That sector currently gaining close to 1%. Industrials also up by 1%. Financial services gaining similar territory. Again, across most of these sectors, fairly healthy gains. One sector in the red, technology down by 0.3%. This is from reports coming through from Reuters and others that TSMC, of course, the chip maker over in Taiwan, has pushed back on summer's deliveries, and that seems to be linking to a little bit of softness coming through for the chip players here in Europe. Anna.
Okay, let's talk about the auto sector, a big feature of the overnight news flow and certainly being expressed in European stock trading this morning. US auto workers have gone on strike as a contract negotiation deadline expired at midnight New York time. The walkout will hit General Motors, Ford and Stellantis at certain locations in several states over in the US. Joining us from Frankfurt is Daniel Roschka, who is a senior research analyst at Sanford C. Bernstein. Very good to have you with us, Daniel. And of course, you're focused on the European automakers, but one of those is involved in this US strike action, and that is Stellantis. Stateside, of course, it makes Chrysler, Jeep, Dodge brands, amongst others, and plenty here in Europe. How does this strike news affect your overall thinking about Stellantis?
Good morning, Anna. Thanks for having me. Yes, look, I think we've highlighted repeatedly that this is a very real, very near-term risk to the Stellantis stock. There's likely going to be cost associated with the strike for Stellantis this year, and there's going to be a union outcome that will add cost to Stellantis's P&L in the North American market to a mild to severe degree, let's say, next year.
Wow, to a mild to severe degree next year in terms of the pressure coming through from the stock on these higher costs. What is their ability, Daniel, for this business, Stellantis, to adjust as they, of course, pour money into that EV transition?
Well, I mean, the first step to realize is that the U.S. is, of course, transitioning a lot more slowly in terms of EV than the European side of Stellantis. For Stellantis in North America, they've also made record margins in those past couple of years, so it's not surprising the union is asking for a large check. In our estimates, kind of a medium outcome of the negotiation could cost Stellantis about €1 in EPS next year.
Okay, that's the impact then on the bottom line. Daniel, if we pivot the conversation slightly to the big European item on the agenda, I suppose, which is around the European Commission's response to Chinese competition. We heard from Ursula von der Leyen this week talking about a flood of Chinese cars, even if it doesn't necessarily look like that on the streets just yet. That's certainly what European regulators are bracing for. What's your thinking around this story? Do you think that there is sufficient subsidy going into Chinese automakers, that this European investigation will find that there's some element of unfair competition, or is this just some fair competition based on competitiveness over in China?
Well, there's no question that the Chinese government and the Chinese economy as a whole has had a really strong focus on building a very good electric vehicle supply chain, from raw materials over refining to batteries down to cars. You know, we'll see if the European Union finds sufficient evidence that they think there's been unfair competition. I think if you look at the regions, though, the approach is very different between China and the US, who are both incentivizing and supporting the buildup of the EV transition in their markets, in the US with the IRA, and Europe basically taking a stick approach where they're saying, you need to be ready by 2035, but the rest is up to you. I think the second point to realize is that this needs to be a really nuanced debate. Today, about 15% of electric vehicles sold in the European Union are from China, or imported from China. A third of that is actually Tesla. 40% is a brand called MG, under the leadership of a Chinese company, SAIC. BYD, the company I think everybody's thinking about when you read these headlines, only is 3% of the 15%, right? So 0.4% of the total EV share in Europe is currently BYD. So it's hard for us to really see a flood of EVs out of China right now.
Okay, so that's the context. Is the retaliation risk real when you think to Beijing's response to this, Daniel?
Oh, absolutely. And if you think about it the other way around, I think Volkswagen, BMW, Mercedes are all very vocal for free trade, and there's a reason for that. They export significant number of high premium cars from the European market into China, and there is retaliation risk, of course. In addition, those companies have very large Chinese businesses, and it's also likely that there could be at least, well, a little bit of more headwind to the Chinese business, even for the Europeans that make cars in China.
How convinced are German automakers broadly, Daniel, that EVs are the future? You still hear some voices talking about being ready to use other energy sources, or being agnostic. Policy should be agnostic to the energy source as long as it is greener than what is on the roads right now. And how behind do you think the European EV push is versus China?
I think, first of all, everybody is committed to the EV transition. I think the discussions you have around hydrogen, for example, are more that, you know, in 2035 and 2040, do we want to preclude today there to be or not to be hydrogen cars? I think as everybody is putting enough investment into the EV transition and is speeding up as we speak, I think that discussion has a little bit too much focus. I would recommend to focus also the incentives from the government on the first point of order, which is transitioning into battery electric vehicles. On the competitive side, it's been the IAA last week in Munich has been really fascinating, because essentially one of the OEMs you would have least expected has presented a car that's actually better than the Chinese tech right now. Renault just launched its Scenic, which is a new EV next year, and it beats BYD's Atto 3 across all dimensions, costs the same in Europe. And so we've seen on the tech that Europeans have been able to catch up quite quickly, and we expect that to continue over the next 2 years.
Okay, that's a really interesting observation. Daniel Roska, thank you very much indeed. Senior Research Analyst at Sanford C. Bernstein on the competition between EU and Chinese automakers, and of course that shift to electric vehicles and the take on that UAW, United Auto Workers strike that is happening right now in the US. Coming up, Wall Street's AI obsession rolls on. We're going to speak to a computer expert who spent 15 years helping build key technologies at chipmaker NVIDIA. Where does it all go next? This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Markets Today. We are 42 minutes into our European trading session. Pretty positive here in Europe, certainly catching a bid as a result of that better data coming out of China. Have we seen that economy bottom out in terms of the negative data story we had been telling? And that is pushing up some of the luxury names, for example, here in Europe. So that's one angle. Commodities also stronger, and that is pushing London higher as well. Now, ARM's successful trading debut could also be having a positive impact on markets today. It underscores how investors are still clamoring to get a piece of the action on Wall Street's AI frenzy. NVIDIA has been the biggest winner among the top players so far. The Silicon Valley chip makers' shares are up over 200% this year, as it's become the world's biggest producer of the specialized chips needed to power a new generation of AI products.
Okay, our next guest has an important place in NVIDIA's history. Jacopo Pantaleone, a mathematician and computer expert, spent 15 years at the company, most recently in the role of principal engineer. He left in July to focus on his upcoming book, which explores AI and other emerging technologies. Jacopo, thank you for coming into the studio. And we want to get your views on regulation and how you see AI evolving. But we do want to start on the question of ARM, given the listing overnight, the success there. They make this claim that they are actually well positioned to play a significant role in AI. The skeptics would say, well, you're focused on a particular type of chip that is better suited to smartphones than maybe some of the compute that's needed for AI. Where do you land in that debate? How well positioned is ARM to take advantage of the upside coming through from AI?
I think this is probably not my main field of expertise, but I would say ARM is actually fairly well positioned. I think like the fact, for example, that NVIDIA is adopting ARM in solutions like Grace Hopper is a good sign.
Which is their most sophisticated chip, isn't it?
Exactly.
Coming through from NVIDIA. And René Haas, the CEO of ARM, has said in an interview with us yesterday that for every GPU, you need a CPU, which is, of course, where they specialize. That's true, is it? And so they can get that uplift from that combination?
I think they're certainly very well positioned.
Okay.
That's my impression.
So that's the ARM focus, and that's certainly caught our attention in terms of the news flow this week. The broader questions, though, around NVIDIA and the AI boom on Wall Street, clearly worth discussing, Jacopo. And so your book seems to focus very much, and it's called An Insider's Guide to Sweeping Technological Change and Its Largest Threats. And it does focus then, does it, on the threats rather than the opportunities?
So, yes. Because I think we are confronting a revolution, the computing revolution more in general, and then the AI revolution in particular, will upend the world order because it is a revolution. But any revolution in history, from the French Revolution to the Soviet Revolution and the Industrial Revolution, had unintended consequences that we couldn't foresee. And this will certainly be true in this case too. So now the question is, what are the main threats, the worst possible scenarios that could materialize? And I think we have to be careful for a couple of things. The first, of course, is we have seen already how the advent of social media, for example, upended the world order in many ways, causing polarization and misinformation and whatnot. What's next there? Social media automatized, essentially, the distribution of news and information and the creation of social networks. And now AI is promising to automatizing a lot of mental work. And so it will be the steam engine of a new industrial revolution, which will be focused on mental work and the production of the industrialization of culture. So one main question there is, will AI cause, for example, an enormous concentration of power? I think this is what actually we are mainly seeing now in the field of big tech.
Okay, so the risks around a concentration of power, and we got some kind of view on that this week with some of the big tech CEOs meeting in the White House, or at least on Capitol Hill, I should say, with senators. And we've all previously had a number of those big tech companies signing up to a voluntary kind of code of conduct around AI in the US. Presumably, you don't think that's enough. When it comes to regulation, is the question about regulating the models themselves or the end use? Where do you land on that question?
I think it should be broader. Regulation should also involve more deeply organizations such as the antitrust, limiting the amount of power that is concentrating in these companies. We have to think that Amazon, for example, in 2022 has spent $72 billion in R&D. This is more than states like France or England or Italy could afford spending. So these powers are starting to have more.
We're very far from that. The antitrust, the appetite for antitrust legislation in the US, and that's where it's most important, is not coming through. We're nowhere near that.
Yeah, we are. So that's why I wrote a book, because I think it has to enter the political conscience of the world citizens. These are increasingly global issues.
Yeah, they are. And those who are slightly more optimistic on the ability that we have to control AI would argue that there are maybe models out there. You mentioned antitrust. Others look to some of the UN infrastructure, as patchily successful as that is. But, for example, regulation of the nuclear industry, and say we should learn from that, because there are models where we can cooperate globally on potentially dangerous technology. Is that something that you touch on?
Yes, of course. But increasingly, I think the focus should be to see things like foundation models, which will be the foundation maybe for the future of work in the next decades, not necessarily next year, should be seen increasingly as public goods, potentially, because they will affect all of our public lives.
Okay, Jacopo, thank you very much indeed. Jacopo Pantaleone, the author of the book, The Quickest Revolution, Insider's Guide to Sweeping Technological Change and Its Largest Threats. Spent 15 years at NVIDIA and also helped build some of the software behind the Matrix and Avatar movies. We need to get you back on to talk about that next time. Jacopo, thank you very much indeed. Coming up, an hour into the European trading day, we're going to break down the moves across these markets. Positive still, European equities adding gains. The biggest stories, of course, driving the session with our Markets Live team. The take on these central banks, the energy complex, and the upside coming through from ARM. Stay with us. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Deserted shopping malls, half-empty apartment complexes, abandoned construction sites. These are all signs of the crisis that has gripped China's property market.
你像北京这么高的房价还挺可怕。这个泡沫将来崩的话呢？
In the early 2000s, there was an enormous construction boom here. There was this fundamental belief that property prices could only go up.
Chinese developers would launch a project for pre-sales, get the money from the home buyers and immediately invest a sum of money into new land parcels, and all worked fine until sales suddenly tumbled.
China's property market is in a bunch of trouble. And because property is the single biggest contributor to China's GDP, when the property sector is in trouble, the rest of the economy is in trouble as well.
If China's economy stumbles, the global implications will be far-reaching.
That was Bloomberg's John Liu there, and you can see that full Bloomberg Originals documentary online and on YouTube, and for subscribers on the Bloomberg terminal and at Bloomberg.com. Let's talk about what's happening in the markets then. Ven Ram joins us from our Markets Live team. Ven, what a week. Lots of data, lots of policy decisions thrown at these markets. More to come next week, of course. The market's then convinced that the ECB is done. Christine Lagarde kind of told us a bit of that, but she also told us not to think that. So what did you make of the ECB fallout?
So, Anna, Lagarde said very clearly yesterday that, look, they're focused on two key inputs. One is the level of holding the rates at restrictive levels. The other is the duration of holding it higher. the markets have taken that to mean that the ECB is done. I don't think that calculus quite works, because if you look at the ECB's own economic forecasts, it expects inflation to be 3.2% next year. And their policy rate is, of course, 4%, which means that their real policy rate is going to be 80 basis points. Now, that works, kind of works, so long as inflation behaves. But what we have noticed all through this cycle is that the ECB has underestimated inflation, which means that if there is a rekindling of inflation and oil prices are going up, it means that the policy cushion that the ECB has is not really a whole lot, which puts an upside risk to the inflation forecast. And it also means that the ECB can't say that they are done raising rates.
And that's really interesting. So the 80 basis point buffer that they currently have and how vulnerable that is to higher energy costs and higher inflation. How do those themes, do you think, play into the decision-making of Jay Powell and the Fed next week, then? There's an assumption from some that they come through with a hawkish pause again. What are the factors around energy and how they think about that?
Definitely, we saw core inflation accelerating on month in the latest print, and that is going to put the Fed on high vigil. And I think what they're going to do is that, as you said, it's going to be a hawkish pause. No one expects them to raise rates next week. But I do think that they are going to say, look, the markets are kind of keen to price in rate cuts in spring 2024. And I think that the Fed is going to push back on that notion. And how are they going to do that? They're going to do that by raising the dot plot for 2024. And I think that will be the key takeaway from the Fed next week.
Okay, so the clue might be in the dots then, or your key message might be in the dots. You focus in some of your recent writing, you focus our attention back on real rates. So where, market nominal rates and inflation meet. What does that tell you? When you look at real rates, what does that tell you about treasuries, then?
The real rates have been soaring since the start of the pandemic. We were at basically 0%, and now we are at 2% almost on the 10-year real yield. And that tells us that there is a structural change going on in the market, and that's a very important structural change that investors need to pay attention to. What is that structural change? At the start of the pandemic, as I said, we were at 0%, now it's at 2%. It tells us something that the time preference of investors is changing. What does that mean in simple terms? In simple terms, it means that investors want to consume now. After the pandemic, they don't want to leave consumption to someday in retirement. They want to consume right here, right now. What that means for interest rates is that if they have to shift that, if they have to forgo that consumption and put that money aside for later, they want a higher discount rate, i.e. higher interest rates, and therefore the real rate is going up and high. And that will keep nominal rate on the boil.
Ben Ram from our Markets Live team, thank you very much indeed for the smart analysis. Remember, you can get us up-to-date analysis and insight from Ben and the rest of the team. Just go to MLive Go on your terminal. That is it for markets today. Equity markets pointing up by, around 0.8%. Tech is a bit of a drag, though. Look at TSMC and AMSL on the back of that. Plenty more coming up. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, Their product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but expand is expand. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. U.S. auto workers strike at the big three car makers for the first time in history, setting up a showdown over wages and job security. China's economy picks up steam in August after a summer travel boom and more support measures from the central bank. Plus, a shot in the arm for markets as ARM soars 25% in its trading debut after raising $4.9 billion in the year's biggest IPO, delivering a boost for SoftBank and its founder, Masayoshi Son. Now, first thing is first, so let's take a look at the European markets map. We're also hoping to get some of the pre-market moves for some of those U.S. automakers for you. Now, so far, stocks in Europe are up, commodities really pushing the decline or pushing the rally after better than expected economic data in China. And that's, of course, fueling hopes that the nation's stimulus measures are starting to pay off. The one currency you need to watch out for is euro-dollar. We'll put it on the screen in just a second, but the euro headed for a record run of weekly declines. You can see the DAX gaining 1%, the CAC 40 actually gaining 1.4%. We'll have a full rundown, of course, of also what's going on with the ECB after we heard from Christine Lagarde yesterday. Now, the other news story we're watching out for is TSMC asking suppliers to delay some of the chip equipment deliveries. Now, that's according to Reuters. Unclear whether that's because they need a little bit more time for the supply chain to normalize or whether this is on political pressure. Certainly, ASML in the market today down 2.9%. So 3 big stories we're watching this morning. Oliver Crook is keeping an eye on the automaker strike. Alan Wan has the latest on the Chinese economy, plus Jake Rudnitsky will tell us about the biggest IPO of the year. So first, let's go to Ollie Crook on the strike by U.S. automakers or auto workers as a contract negotiation deadline expired at midnight New York time. The walkout, Ollie, will hit General Motors, Ford, Stellantis at really strategic locations in several states. So what does this mean for the near future?
That's right, Francine, and this is sort of a historic moment where it's hitting all 3 at the same time, and it's 3 companies, 3 different states, 13,000 workers. What are they asking for? 36% increase in wages. They're talking about a 4-day work week and also talking about a COLA, a cost of living allowance, to basically insulate their paychecks from all of this inflation that we've had in the recent years. And the automakers, they've offered GM and Ford 20%, Stellantis, they've offered 17.5%, but that has not been enough. We are on strike today, so the rest of the workers will continue to work on an expired contract, but it could escalate very soon.
So, Ollie, what's the strategy here for the union?
So what's really interesting is that they've gone progressively. Yes, 3 companies, yes, 3 states to show the reach that they have, but only 13,000 workers. Remember, they have 150,000 workers. So they're keeping dry powder, which the president of the union said he's willing to use.
This strategy will keep the companies guessing. It will give our national negotiators maximum leverage and flexibility in bargaining. And if we need to go all out, we will. Everything is on the table.
So everything is on the table. They could expand this strike at any moment, really keeping them guessing. But the problem that the union has is they have a strike fund, which is limited. That continues to compensate workers that are not working. If all 150,000 workers went on strike, that could last only 11 days. So what they're doing is strategically targeting the factories and assembly plants that create the highest margin cars in order to put maximum pressure on the automakers.
Ollie, thanks so much. Oliver Crook there in Frankfurt now, or actually Berlin. Economic activity in China gathered pace last month with industrial production and retail sales coming in better than expected. Well, joining us now is Bloomberg's Shenzhen Bureau Chief Alan Wan. So, Alan, good morning. What were some of the highlights, lowlights of today's data?
Well, the highlights you just mentioned, industrial output and retail sales grew more than 4% last month, much faster than expected. And this just follows in a recent, it shows that the growth is stabilizing in China. The economy is starting to stabilize. We've had recent data showing exports and manufacturing, the pace of decline is moderating, credit recovering, and even deflation starting to ease. So this sort of reinforces the belief that that part of the economy is starting to stabilize. And even on youth unemployment, the government said that the youth unemployment had improved, although we don't have any data to support that. We're just going to take their word for it. In terms of lowlights, it's still the property market. Yep. Home prices fell more than expected, and the fixed asset investment grew slower than expected due to declining property investment.
Alan, thanks so much. Alan Wong there with the very latest on the Chinese economy. Now, shares of chip designer ARM also climbing 25% in their trading debut in New York. That's after they delivered a boost for both equity markets and SoftBank. So let's get more with Bloomberg's Jake Brunitsky. Jake, what did we actually learn from ARM's first day of trading? They flew off the shelf for now. Can they keep it up?
Well, it looks like the IPO market is back. Up until ARM's debut, the IPOs, it has been the worst year since 2009, so basically the financial crisis. And with ARM coming out roaring, it looks like there's going to be a lot more interest in companies going public. The pipeline is looking pretty positive.
So does this actually mark the start of an IPO revival?
Well, it certainly does look like it, and it's not just tech companies. We do have companies like Instacart that are planning to list, but also Birkenstock, the German footwear maker is looking at it, and it sounds like there are dozens of companies that are exploring IPOs right now, and so it looks like there's a lot of pent-up demand.
All right, Jake, thanks so much. Jake Rudinski there with the very latest on ARM, one of the biggest so far IPO this year. Now, coming up, we dive into the markets with Daniel Pinto. He's founder and chief executive of Stanhope Capital. Now, we get his thoughts, of course, on the much talked about chances of a soft landing for the U.S. economy. That's next, and this is Bloomberg.
Connection lost.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg. The conversations that matter, the insights you need. This is A Pulse. I'm Francine Lacqua here in London. Also, happy Friday, everyone. It has been a long week for most market participants. Now, some pretty strong data from the U.S. economy has revived speculation that the Fed will be able to engineer a soft landing, even if it keeps interest rates higher for longer. Well, joining us now is Daniel Pinto. He's the founder, chief executive, and chairman of Stanhope Capital, an asset management firm he started back in 2004 with $27 billion of assets under management. So Daniel, thank you so much for coming on to give us a little bit of a glimpse of what you're looking at. Now, I guess the premise of how you do your investment strategy is the U.S. is growing more than Europe. So we have charts which we'll show in just a second. But what do you worry about for Europe?
Well, the first thing to say is that so far so good for the Federal Reserve. They have been able to manage this fight against inflation pretty well. But they are at a tipping point, which is that they will have to announce a decision next week. My view is that they should stop raising interest rates, and they can absolutely organize a soft landing. I am much more concerned about Europe. We are in a position today where inflation in Europe runs at about 5.5%, where GDP growth is nil, where Germany is probably in a recession, and where pretty much the ECB is stuck between a rock and a hard place, which is, on the one hand, they say we might be done with raising interest rates, happened yesterday, but at the same time, inflation is still at 5.5. And there is the danger zone, if you will, because if they make the wrong move next time, they can actually tip the European economy in a deep recession as opposed to a mild recession.
Daniel, what is a wrong move at this point? So what they're thinking is they stay, they pause, although she didn't 100% commit to it, President Lagarde, and then you see what happens to this extremely fast tightening of interest rates.
Yeah, I think they should take the risk. I would agree with the position that they seem to be taking, which is not to raise interest rates. I mean, to do it for one last time, but then pause. Because, again, if the trade-off is let's run with higher inflation or let's tip the European economy into a deep recession, obviously they have to accept a bit higher inflation. That is the best trade-off. And I really hope they do that. They seem to be heading in that direction.
Daniel, this is probably the chart of the week, if not the quarter, and it's looking at consumption, and this is something that you highlighted to us. It's basically the difference between U.S. and EU consumption chart, and you can see how these two economies are bifurcating or certainly are behaving very differently. Again, are these structural concerns that Europe can fix, or is it just because of the proximity to Ukraine and the energy complex?
No, I think that there are structural concerns. Just to give you a couple of figures, in 2008, the U.S. economy and the European economy were roughly of the same size, about $14–15 trillion. Today, the U.S. economy is worth about $28 trillion, and the European economy is still at $14–15 trillion. No growth. Point number one. Point number two, you look at consumption expenditure. It was about $12.5 trillion in 2008, both for the U.S. economy and for the European economy. The European economy has stayed flat, no additional consumption. The US is at 17–18 billion. So this is absolutely structural. We have lost the key, we have lost the formula for growth in Europe. The US, in spite of everything people say, has maintained a degree of growth, largely fueled by technology. And one of the concerns is that we are laggards in terms of technology in Europe. UK and Europe. Just to give you a sense, today technology stocks represent about 30% of the S&P. They represent only 7% of the European economy, of the European market. And because these stocks have been the biggest producers of earnings, then you wonder, why has the US market outperformed Europe? Well, that is the reason. We have missed on the biggest source of earnings growth for the last 15 years.
But this is not a lack of innovation. You have companies like ARM, British-born, and then listing elsewhere. So is it a lack of capital to grow, or is it really, again, a structural problem that maybe policymakers need to fix?
This is, first of all, an ecosystem in Europe which is bad at investing in growth companies and technology companies. And that's true in the public markets, and that's true in the private markets. If you look at the public markets and take the case of the UK, pension funds used to be very active participants in IPOs, in equity markets in general. They used to own about 50%. 50% of their portfolios used to be comprised of UK stocks 20 years ago. Now it's 5 or 6%. So if you do not have the engine of capital to support growth, guess what? Companies that are the fastest growing companies prefer to go to the US as ARM did. And that's a major problem for us. So it's not a lack of innovation. It is partially a lack of innovation in areas related to digital. I think we have our champions in Europe, if you will, tend to be in hard tech, not in soft tech. But it's also a fundamental problem in terms of capital available, both in public and private markets, for innovation.
But is there also worry that some of the capital is being sucked into private assets? So this could be private credit and private equity.
In part, I think that it is a fact, a growing appetite for private debt in Europe, etc. And I think you see a lot of these big institutions, instead of funding innovation and growth, they go for lower returns in private debt because they feel it is safer. And it is a problem. You cannot dictate to them to do what they do with their funds. But you're absolutely right to point out that the money is heading in the wrong direction.
What do you worry about the most for Europe? I know we talk about the fact that nothing's broken despite interest rates, having risen by so much in so little time. Are you expecting defaults in this kind of situation where growth is not as strong in the US?
I worry about stagflation in Europe. I worry about a position where inflation comes down, because it will come down, but where growth is anemic, and where you have a period of a year or two of stagflation. And the problem with stagflation is that it kills corporate margins. In other words, you see companies making less and less money and sometimes losing money. We worry about that, and that's why we have said to our clients, not just recently, but for the last few years, that they should have the majority of their equity exposure into the US.
Okay, Daniel, thank you so much. Daniel Pinto, their founder and chief executive officer of Stanhope Capital, stays with us. In the meantime, I need to bring you a couple of stocks pre-market. So they'll be, of course, they're listing in the U.S., so we'll see how they open in a couple of hours from now. But for the moment, ARM. So let's see whether we have that stock. ARM, of course, this was the big story yesterday. And you can see yet again another rise after it's risen quite significantly on its debut yesterday. Pre-market today, ARM Holdings gaining 9%. And then the other story, of course, that we've been following very closely are some of these strikes by Detroit car makers after deadlines for new contracts actually lapsed. I think we also have that pre-market. You can see Ford and General Motors down 1.9 and 1.6% respectively. Now, coming up, we get the latest on the world's second largest economy as China reports better than expected industrial production and retail sales. We're back with Daniel Pinto. This is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Wall Street is waking up. Europe is already trading. And starting Monday, Manus Cranny and Danny Berger will make sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, premiering Monday, only on Bloomberg.
Welcome back, everyone. Now, still with us, Daniel Pinto, Stanhope Capital founder and chief executive. Daniel, thank you, first of all, for sticking around. We were talking a little bit about, I guess, the dynamics between the U.S. and Europe. When you look at ARM and the fact that they listed elsewhere, is this really symptomatic of how the UK is hurting?
Absolutely. Sadly, all these companies that have the prospect of valuing themselves at very high multiples across the Atlantic don't even hesitate. They just go for a listing in the US. And the reasons are clear. There is a much deeper pool of investors in the US. Number two, the UK sadly has lost its desire to invest in growth companies. As you know, most investors in the UK are value investors. They love high dividends. And guess what? If you are a value investor enamored of high dividends, you just invest in traditional companies, not in companies like ARM that are going to trade at 100 times earnings or more. And so that is a malaise, if you will, that is affecting London. And unless it is fixed by changing pension rules, by changing rules affecting insurance companies, it will carry on, sadly.
Who will change that? Is it this government or is it the next government?
Well, this government is saying the right things, but is very, very slow for some reason. You know, they've been talking about changing listing rules for months, maybe a year, and it hasn't happened yet. They've been talking about doing something about pension funds and promoting mergers between pension funds to create, giants. Hasn't happened yet. So, unfortunately, time is running out because we are losing traction. Just to give you a sense, 20 years ago, there were 3,200 companies listed in the UK. Today, half. We have lost 1,600 companies that are no longer in the market. And so it is costing us a lot.
Daniel, I also want to get your take on China, and there's a great chart that, again, this is one of the charts that you look. I don't know whether you look at it weekly or monthly, but certainly it's one of the ones that you highlighted, which is looking at Chinese debt. How does this end? When you see, I mean, this is an exponential,
well,
like
this is really
increase.
concerning. I mean, everyone is focused on the positive news that came out yesterday about numbers being slightly better in China. I think it's great, good news, but there are bigger issues affecting China. One is the share of real estate in the Chinese economy, which is 21% of China's GDP. Just to give you a sense, in the US, real estate is only 15% of the GDP, 21%. And we know that the property market is in shambles. And that affects everyone. It affects, any Chinese household. It affects banks. It affects the government. It affects everyone. So this is a very, very strong headwind against the Chinese economy. The second one is the level of debt overall, financial and non-financial debt, which has far outpaced the growth of GDP. And that is really a problem.
But could there be a credit event, a financial crisis because of it, or will it be well managed by the Chinese policymakers?
I don't think it will be a credit event, but I think that the Chinese authorities will have to dig deeper in their pockets if they want to avoid a credit event. I think they are very conservative in their fiscal stimulus package. Yes, it's impressive to talk about hundreds of billions, but given the scale of the issue in China, it requires much more than that. And I think the Chinese government is behind the curve. It's not ahead of the curve here.
Daniel, so I had forgotten that this is the 15th year anniversary of the Lehman Brothers collapse, but one of my favorite authors, John Authors, has a great piece saying, look, happy Lehman Day to all who celebrate. And actually, he argues that the echoes are still with us 15 years later, rippling through Europe and China because of some of the things that happened post-Lehman. Do you see a pre- and post-Lehman world?
Yes, I think the Lehman bankruptcy is like a major event, like the death of John Kennedy. Everyone remembers where they were when it was announced. I remember vividly where I was when the announcement of the bankruptcy happened. Yes, there is clearly a pre and post Lehman world, and I think that, to their credit, I mean, a lot of people criticize central banks. I think central banks have been the saviors of the system in post 2008 and after, and I think one has to credit them for that. And the turning point, as far as the Lehman event is concerned, is to understand that the market itself cannot fix all these issues. You need government and central banks to play a big role.
Daniel, thank you so much. Daniel Pinto there, Stanhope Capital.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. Some of the things that one reads about now remind me of growing up in Mississippi.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg.
Now, U.S. auto workers strike at the big three car makers for the first time in history, setting up a showdown over wages and job security. China's economy picks up steam in August after a summer travel boom and more support measures from the central bank. Plus, arms stock higher pre-market, this after soaring in its trading debut after raising $4.9 billion in the year's biggest IPO. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, ECB Governor Christine Lagarde has raised the European Central Bank's key lending rates by 25 basis points, its 10th consecutive hike. Now, for more on all of this, let's get straight to Bloomberg's Alexander Weber in Frankfurt. Alex, first of all, I know you break news almost every week, so congratulations to you and the Frankfurt team. But were there any signals in Lagarde's speech that the ECB is now done hiking, and how did the markets take it?
Yeah, so the clearest signal may have come in the policy statement already. They introduced a very long and finely nuanced sentence that most took to mean that interest rates have now reached the peak. Lagarde didn't quite want to confirm it in the press conference. She said the Governing Council can confirm that now. But she acknowledged that the focus is going to shift to how long rates will now stay at this restrictive levels, not so much to where they will end up. The market certainly took it to mean that the peak is in. Investors are not pricing any more hikes. Analyst notes, if you read them, nobody expects any more hikes from here on out unless there's a very significant surprise in the coming data in the coming months.
So the ECB has also revised its economic outlook out to 2025. What exactly are the changes?
So the most important change may have been that the near-term outlook for the economy was revised lower. The ECB only expects 0.7% growth this year. Many expect this to be actually too optimistic because the cutoff date was before Eurostat revised down the growth figure for the second quarter. Inflation, on the other hand, was revised up for next year and a bit down for 2025. So the ECB now expects to reach a 2% target in the second quarter of 2025 already. This may have been behind the decision to hike. They didn't want to risk pushing out that date any further. Lagarde said in the press conference that the difficult times are now. They do not expect a recession, but it remains to be seen whether that pans out, and especially how the labor market reacts if growth surprises on the downside in the coming months.
Alex, thanks so much. Alexander Weber there on the very latest from the ECB. Now, for more on the ECB, Europe's economy and markets, we're also joined by Sfia Salim, Bank of America, head of European rates strategy. Sfia, thank you for joining us. Okay, 25 basis point hike, as expected. Were you surprised in Christine Lagarde's language that actually, first, she didn't pre-commit, but she's sticking to the higher for longer?
Yes, thank you for having me. But certainly, we were expecting the door to rate hikes to be left a little bit more open here, because it is going to be challenging for the ECB to really convince the market that it's not going to cut rates anytime soon. And one way to convince them is to still leave the door open to those additional hikes. So we were a little bit surprised by the fact that it was a little bit more explicit that they were contemplating a pause here. But we would call that a Schrödinger pause at this stage because, as we saw, there are already some hawks that are pointing to the fact that a December hike cannot be ruled out.
So, Sofia, how hard is it right now to set monetary policy for Europe? Because I guess even an extra 25 basis points could really unravel the economy.
It is extremely hard, of course. This decision taken yesterday was probably one of the most difficult ones so far in the cycle. And this is the case also for other central banks, which are grappling with inflation being still elevated and first signs of weakness in the data. But what I would say is that at this stage, we are dealing with a central bank that still wants to keep all options open, because if you look at the hard data, it has actually outperformed soft data. So we are seeing signs that actually the economy may be a little bit more resilient than we thought. This is certainly the case in the US, but it could also be the case in Europe.
So how high is the bar actually for raising again, and what does it mean for a lot of the fixed income space in Europe?
The bar is certainly very high. Our baseline is that 4% will be the terminal rate here. And it is true that for fixed income investors, there is this desire to buy duration around the last hike. But we would caution investors of doing that too much in the next few weeks, for sure, because positioning is already long. The end of cycle is a consensus trade, and small upside surprises in the hard data can certainly still push upward pressure on 10-year yields, in particular in Europe.
So how early do you think we could see cuts? I mean, is it just wishful thinking from the markets?
Our baseline is still that there will be cutting in the middle of next year because inflation is on a downward path, and we are dealing with a central bank that has already been in very restrictive territory, so it makes sense that there are cuts happening as inflation converges towards 2%. But at this stage, I think that overall pricing will be quite stable for the very front end of the curve, and it is assessments of the neutral rate and assessments of term premium that can still put pressure on 10-year yields.
So there's a lot going on with euro. How much pressure will euro see from here until the end of the year?
We still see some downward pressure because it's a relative issue, and we have data that actually comes in still stronger than expected in the US. So our FX strategist call is still that the euro weakens towards 105 by year end.
How much volatility overall? I know you're expecting, I guess, a little bit less volatility in the 2-year rates, but is there a credit event that you worry about in Europe that could really kind of change the game for the ECB?
I mean, there are, of course, a lot of unknowns there, and a shock like the one we have seen in the US can bring forward the pricing of immediate rate cuts. But we don't see anything immediate. What we're watchful for is the tightening of financial conditions that can come from the TLTRO repayments at the end of this year and at the end of March next year.
So when you look at China, I don't know whether you worry about stagflation in Europe, and really depending on what happens in China, it could completely unravel and the ECB loses control there.
We are thinking that the market is very much pricing already the weakness in China. When we survey our investors, most of them expect simply some piecemeal measures to be taken there. So there's a lot of pessimism, I would say, that is already embedded on that story.
All right, Sofia, thank you so much for joining us. Sofia Salim there, Bank of America, head of European rates strategy on the ECB, and much more. Now, coming up, sneaker demand spiked following the pandemic. Data suggests the peak has passed. Well, we're joined by Silvio Campara, the chief executive of Golden Goose, the brand behind Taylor Swift's favorite sneakers. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacroix here in London. Now, Bloomberg has learned that media mogul Byron Allen has admitted a $10 billion offer to Walt Disney to acquire its ABC TV network and several other stations. Now, for more on this, let's bring in Bloomberg's Alex Webb. Alex, I mean, this is an exciting deal. It's a potential deal. We haven't seen that many deals in this space. Is it because the price is attractive, or it's just the beginning of a consolidation phase to keep costs down?
Yeah, it's this sort of like rejigging of who runs what in media, essentially, because what we've seen with Disney is they have been going into, of course, streaming. There isn't as much growth as there used to be. There's not really much growth at all in linear television, where you're fundamentally dependent on advertising. The thing they've also managed to do at Disney, they, of course, had all these assets they acquired through Fox. A lot of those are the things actually that are feeding Hulu, which is kind of the platform you might think have been taking content from ABC in the past. So it is interesting that Byron Allen is now coming in. It's a $10 billion offer, $10 billion offer that Bloomberg is reporting, according to sources. And the fascinating thing here, though, is I think there's wiggle room, right? In this reporting, it says that that's based on the assumption that the properties generate $1.25 billion in EBITDA. If it's higher than that, then the offer goes up. If it's lower than that, the offer goes down. So you sort of wonder how much diligence has been done on this, right. But it's, there's a long way to go.
And what's happening at Disney Plus?
Well, ultimately, the subscriber numbers aren't as good as had been expected by the previous CEO, Bob Chapek. That's for a number of reasons. They've increased pricing to offset some of the stagnating growth. It's a sort of chicken and egg thing there slightly. And also in India, where they don't have the cricket rights in the way they had before. And that means that subscribers in India have dropped off quite considerably. The value of subscribers in India isn't actually all that great. Some estimates I've seen suggest they make, 70 cents a month, whereas they make $7.50 in North America. So it's not as appealing from a revenue perspective, but it is from an audience perspective.
Interesting. Thank you so much, Alex Webb, there with the very latest on Disney. Now, I also want to show you what chip designer ARM is doing. Yesterday it was up 25% after it debuted a pretty big win, actually, for owner SoftBank. Pre-market, it's still gaining in today's trading session, 9% higher. Now, the conversations, of course, that matter. Coming up, we bring you a conversation with the chief executive of Golden Goose for London Fashion Week. This is Bloomberg.
deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Welcome back. So sneaker demand, or trainers, because I'm going to get in trouble with my British colleagues. Trainer demand has spiked following the pandemic, but data actually suggests that the peak has passed some time ago. Now, Golden Goose is a favorite brand of celebrities like Taylor Swift and Selena Gomez. It's aiming to appeal to the environmentally conscious Gen Z by offering in-store cobblers, for example, to repair their $500 shoes. Now, despite inflation squeezing European consumers, Golden Goose reported 25% growth in the first 6 months of the year. And joining us now is Silvio Campara, Chief Executive of Golden Goose. Silvio, thank you so much for joining us. I mean, you have a pretty extraordinary stories because, you know, when you started out, a lot of people would say, well, how many pairs of trainers or sneakers do people want? And you've managed to put yourself in price point, but really at the top end of desirability. Can you grow from here?
Seems that, you know, in the last 23 years, we've been growing, okay? So it looks like, you know, there's still space, not just for sneakers, but for the way we approach sneakers, you know? So we are coming from the 90s, 80s, 70s, where sneakers, it was mostly about performances, so to jump more, to running faster. And then I would say that Golden Goose probably has been one of the pioneering in shifting everything from performance to emotions, sentiments. So now sneakers are not anymore just an object, but these memories that you can collect along the years.
But so this is through experiences. But again, what makes people buy a $500 sneaker? I think is probably the question for investors.
The uniqueness of the items, because, you know, there's a specific strategy behind. Because it's easy to get bored about a sneaker because usually you don't pay that much attention because it was more functional. While, you know, Golden Goose has been the first to have a completely unique approach in changing the merchandise strategy by giving to the audience and the lovers a different specific offer depending by region, by channels, by city. Right. And this is making, you know, the people excited and having always the feeling of collecting the items. And for sure, you know, we never do replenishment, you know, which is quite unique. So every single piece you buy is one. And one last thing, we are the only brand on earth that do sneakers handmade.
So first of all, is there a price sensitivity, or actually do you feel like you can actually increase and that's not a problem, which means that you have very healthy margins and that will continue to be the case?
No, I think sneakers are not bags, so there's no space to increase that much the prices. So of course there's a bit of inflation inside, but there's not that much space. I think it's very important. It's part of the marketing and the sustainability, the real sustainability that to me is first of all the relationship between you and your people.
So you were telling me, I think you sell 2 million Right,
Yeah.
sneakers a year. That's pretty
Yeah, in
incredible.
units,
So
yes.
is this what, U.S. mainly, or is it really across the
It's
globe?
almost 45% of our business, and I would say all over the world. We are more than 92 countries all over the world.
And so are there regions where actually demand can increase more significantly than it is now?
Yes, and I mean, it's not me that can say that. I mean, it's the fact, you know. If you look at sneakers, it's not just a category. It seems to be the gate for all new luxury consumers. And so what is really brilliant and amazing and can give the real answer to your question is the age of our consumers. Because, you know, bags is mostly on millennials and next generations, while sneakers can really open to you the wide and huge basin of Z generation, so actually giving you the longevity of the business rather than just the verticality of the business.
Okay, so you're selling to a younger population.
Yeah, not only, but you know.
Which is brilliant, because this is maybe what some of the other legacy brands want. How do you sell more to them? Is it different categories or just by doing the same? Organic,
you know, because the new generations are now into status, they are into relations, you know, human relations. And seems that our execution, you know, is really into that, and since they are happy and they are repeating and repeating and repeating and promoting and promoting. So word of mouth is really important.
There's a trend towards quiet luxury, and I know there's been, you know, Netflix shows because of Succession and things like that. Is that the space where you see yourself? Are you quiet luxury, or are you not so quiet luxury?
No, I'm not surprised about that. Yeah, I think, you know, I think we are the result of the reality outside there. So there's very little strategy in Golden Goose, and there's really a lot of organicity, you know, in what we are doing. Yeah.
So talk to me a little bit about your plan. I mean, would you IPO? Birkenstock did a very, very healthy IPO. Is it something that you would consider?
First of all, congrats to Birkenstock. And in my case, you know, my job is really to give multiple options, you know, to our shareholders, and that's my job, you know, to really make that. So if eventually in the future there's going to be that option, why not?
What are market conditions looking at? I mean, do you test market conditions to make a decision on a possible IPO?
No, the most important for me is to have really a strong narrative and to make sure that we have a strong vision in order really to make the brand and all our people, you know, be the strongest and the most excited possible.
So talk to me a little bit about the close. So this is what, 10% of your revenue?
Yeah.
Is it a tougher market because of, you know, rivals or certainly many other designers out there, or is it supply chain issues, or are you just happy with having it as a 10%?
Yeah, I mean, our business is sneakers, so, you know, our priority is to make sure, you know, to be strong in there, ready to wear is part of the narrative, but it's not our priority.
So you're here for London Fashion Week.
Yeah.
Has London changed?
We always love London. We think London is unique in terms of energy, in terms of communities, and I think there's still a lot that we can grab from London and from his incredible ability to rechange, you know, itself. So.
I mean, you also have this interesting collaboration with cobblers that come in certain of your stores.
Yeah.
Is there anything else in the pipeline? I don't know whether it's, you know, is that the model that you just want to offer, whether it's an experience or even some collaboration maybe that's
it's not one of the experiences. Our experience is very clear. We want people to be part of the process. We want people to be part of the change. So same as, you know, with the co-creation, we help people to unleash their creativity. With the repairing, we help them to be part of this, making the world a better place. So there's no sustainability without having the people engage with you. So this, if you ask me what is our mission now, is we did an amazing job in these first 3 cities, so now we need to bring this to the world.
How many pairs of sneakers do you have?
Myself?
You, yourself?
Honestly, more than 3,000, yeah.
Wow. Okay, that deserves a whole show in itself. Silvio, thank you so much for coming on. Silvio Campana there, the Chief Executive of Golden Goose. Now, let's also get to some of today's other top stories. BP looking both internally and externally for a new Chief Executive Officer to replace Bernard Looney, who left his post abruptly after failing to fully disclose relationships with colleagues. Now, the chairman, Helge Lund, told staff in a CEO search process has started. Looney's sudden departure after less than 4 years in the job means there was no succession plan in place. Now, the U.S. president's son, Hunter Biden, has been indicted on federal charges of lying about his drug use when he bought a gun 5 years ago. It follows the collapse of a deal under which Hunter Biden would plead guilty to misdemeanor tax crimes and to acknowledge a firearms violation without a conviction. Now, the indictment actually means that he could go on trial during next year's election. The president's son has said that he was in the grip of a long-standing struggle with substance abuse. And the state of Georgia's plan to keep Donald Trump and 18 other defendants in a mega trial over the 2020 election has actually fallen apart. Now, a judge split the prosecution in two and said further divisions may be necessary, leaving the date of the former president's trial up in the air for now. Britain, France, and Germany reported to have announced they will keep their sanctions on Iran related to its atomic program. The measures were set to expire in October under a timetable in the now-defunct nuclear deal between Tehran and world powers. Now, the European allies say the move is due to Iran's severe non-compliance with the accord. Now, coming up today, the EU Economics and Financial Affairs Ministerial meeting is taking place in Spain, so don't miss our exclusive interview with the Spanish Economy Minister, Nadia Calvino, on the Surveillance Early Edition, and that's at 10:30 a.m. London time. Also, later today, our conversation with the French Finance Minister, Bruno Le Maire, that Bloomberg exclusive just after 3 p.m. London time. Now, the other thing, of course, we keep on watching is what's going on with ARM. This is the biggest IPO of the year. ARM pre-trading actually getting some 9% yesterday. After it listed, it had a pretty big boost already. So there's a lot of questions about whether they still decided to go in the US instead of Europe, what that means for everything else, of course, for other companies that want to list here. Now, ARM's highly anticipated trading debut really has caught the attention of retail traders. For example, if you look at the chip designer, it garnered the most buy orders on Fidelity's trading platform with an upward of 20,000 purchase orders. Up next, Bloomberg Surveillance Early Edition. This is Bloomberg.
That given that we have this productivity enhancing technology that is AI, that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working, so there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. That the big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962, at the time of the Cuban Missile Crisis. Yeah. I don't believe for a minute that we can have a Cold War II without a similar risk.
business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. China's economy shows more signs of stabilizing thanks to a summer travel boom and a heftier stimulus push. Bloomberg speaks exclusively with Spain's economy minister as ECB officials squabble over further rate hikes. And U.S. auto workers go on strike, setting up a showdown over wages and job security. Welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London alongside Shonali Basak in New York. Shonali, what a busy week. It doesn't get any more calm. We have good news in the form of China and then that strike now from the United Auto Workers to contend with.
Certainly sets up for a complicated story in the markets, but we are looking, Danny, at an S&P 500 that is still on the rise this week. Not a massive lift in futures today. However, remember, we are on track to end the S&P on a high week that sets September on course to potentially end the month in the green after a lot of worries about a decline, a market decline, some jitters heading into October. Now, S&P futures strong. The two-year yield also on the rise. We're standing at 503. The reason this is so interesting, a 2 basis point move. However, at this time yesterday, we were well under 5%, around 498. This two-year yield, intraday volatility, has been a 10 basis point swing over the last 3 days. So we'll keep an eye on that on the heels of strong economic data in the United States ahead of critical FOMC communications. Now, the Bloomberg US Dollar Index is getting some cooling here. This is off its highs of last week, but has faced some strength throughout this week. So we will watch it going into next week. Brent crude, this has just been a stunning story. You are looking at Brent at a 94 handle, Danny. At 90 last week, that looked like a stunning move. We have still been on the rise. Remember, stronger economic data here in the United States, as well as some signs of promise abroad, particularly in China. We'll get to that story. WTI, Danny, also has been hitting above 90. I want to flip up the board and take a look at one stock that has certainly caught the eye of many investors, both institutions, large corporations as anchor investors, as well as the retail crowd. You have ARM Holdings still on the rise in pre-market trading, up more than 9%. This is a stock that got an IPO pop yesterday, certainly inking a win for SoftBank's Masa-san. Remember, ARM at $69 a share brings it well above that price that SoftBank had bought its share back for from the Vision Fund just weeks ago. So a win for SoftBank, a win for 28 underwriters, including Goldman Sachs, JP Morgan, Barclays, and Mizuho, Danny.
Well, that theme might be continuing of a rally in ARM, but in Europe, we're looking at a mirror opposite of what happened yesterday. Yes, the ECB hiked, but we had a weaker euro, and we also had bonds which rallied too, the idea being that it was one and done, that they would have to start cutting. We're getting the opposite of that. There's an FT story that the hawks want potentially another hike later this year. Euro strengthens. Meanwhile, you're looking at duration in Europe. This is interesting, completely undoing the rally of yesterday. Yields for the 10-year yield are about 5 basis points higher. Meanwhile, in Europe, stocks are higher, up less than 1%, but still a good chunk, really all because of China. LVMH, the biggest gainer, the biggest contributor to that gain. If China's doing better, then surely the luxury goods will do better too. Shonali, some other breaking news here in Europe and look, in the U.S. too. The Americans are coming for English football. Miami-based 777, the private equity fund, has just announced that they will acquire 94.1% of Everton. That's, of course, the English Premier League club, from its owner, Farhad Mashuri. Again, they just released a statement. We're seeing more and more of this. Shanali, Americans just love football. And 777, I should note, is already an investment fund that has other stakes in other clubs, too, throughout Europe. So this is a trend that's just picking up in speed.
It sure is, Danny. We are looking at the tick up in speed in sports assets across the world for sure, but English football has certainly been at the forefront of the activity when you look at private equity firms in the United States and sovereign wealth funds around the world. Now, we are going to shift gears here. We're going to talk about China's economy because it had picked up steam in August after a summer travel boom, and a stimulus push had boosted consumer spending and factory output. Joining us now is Bloomberg's Alan Wan in Shanghai. Alan, how has China seemingly been able to turn things around? And is this data significant enough to believe in a significant uptick?
Well, I tell you, this data, I mean, industrial output retail sales grew much faster than expected. I mean, it's just boosting speculation that the economy is starting to stabilize. I mean, mind you, this is just the latest in a recent slew of positive data. You had manufacturing and industrial manufacturing exports showing moderate declines recently, credit recovering, and even deflation is easing. So, I mean, this is all bolstering speculation that, you know, the economy is starting to stabilize. And why is that? Basically, it's just starting to show that all these stimulus measures that the government undertook over the last few months and probably support measures are starting to bear fruit. Interest rates cuts and reductions in the RR ratio. And interestingly, the government cut the RR again for the second time this year, releasing 5 billion yen in funds for the for lending.
Alan, so can we say success yet? Or are there other concerns you're still looking at that overshadow some of this good data?
Yeah, I think it's premature to say success. I mean, maybe in broader parts of the economy, things are looking better, but the property market is still looking pretty wobbly. I mean, home sales dropped, last month much more. Home prices, dropped more than expected last month. And even fixed asset investment growth there slowed quite a bit because of declining property investment. And then the developers are still in trouble. They look very stressed. Country Garden announcing that it's going to delay another vote on his request to extend payments on his yuan bond, and then even Sun Ocean, a state developer, saying that it's going to suspend offshore payments. So I think that's definitely a cause of concern, the property market.
Yeah, definitely is. More of those deadlines coming up for Country Garden. Alan, thank you so much. Alan Wan reporting from Shanghai. Now, the ECB delivered a 10th rate hike, and now hawkish policymakers have told the Financial Times that the central bank may still not be done. Yesterday, President Lagarde refused to exclude another hike as well.
The focus is probably going to move a bit more to the duration, but it is not to say, because we can't say that now, that we are at peak.
The market, however, has decided something different. Joining us now to discuss is Bloomberg's Valerie Teitel. I mean, the market is saying something so different than Christine Lagarde. Even just holding for a long time would be a surprise at this point.
Look, she's not going to say it out loud in the press conference, but the amends she made in the statement yesterday were the clear sign in central bank speak, could we add, to the markets that they are very much done raising rates. Now, it's interesting to see that we're still seeing some ECB squabble the day after a decision. We had that FT article, as you mentioned, the ECB hawks warn of a December rate rise if inflation and wages stay hot. We also heard from ECB Guindos saying, towing the line a bit more about what Lagarde said yesterday, saying 4% for a prolonged period will do the work on inflation. ECB's Mueller also saying that no further rate hike is needed in coming months, but he did threaten an additional one if inflation persists. All of this being said, Danny, is doing, I think, very little to change the sentiment on the front end of the European curve. Given how downbeat they were on growth yesterday, the market is essentially saying the bar is very high for more rate hikes from the ECB, and we look ahead to cuts now. If we look at the very front end of the Euribor curve, 75 basis points of cuts is now priced for 2024.
It's worth talking about the Bank of Japan also, because next week we have some pretty critical communication coming out of the FOMC as well as the BOJ. What are market expectations given that you have investors so sensitive to anything coming out of the Bank of Japan?
It's funny you bring up the Bank of Japan. We had some lines from the BOJ, from BOJ sources this morning, which caught the market's eye, remarking that Ueda's remarks over the weekend were not meant to be taken as a new policy signal. It's almost like the Bank of Japan is trying to put the cat back in the bag, but the cat is very much out of the bag. The market does think that there will be a shift in BOJ policy, not next week, Sonali, but possibly towards the end of the year and into 2024. The market is expecting the Bank of Japan to shift into a tightening cycle and lift those front-end interest rates. But it's interesting that we do see these Bank of Japan sources pushing back on the market reaction from Monday. Remember, it was only back on Monday we saw the yen strengthen over 1%. JGB yields spike higher because of those Ueda comments that wages could be sustainable by year-end to warrant a tightening cycle. The BOJ does meet next Friday. Maybe a bit of a narrative shift ahead of that meeting.
Valerie, thank you very much. That's Bloomberg's Valerie Teitel. All right, let's move on to the U.S. auto workers now, because they have begun an unprecedented strike at all three of the legacy Detroit car makers after talks fell. UAW President Sean Fann spoke about the union strategy.
If we need to go all out, we will. Everything is on the table.
Everything is on the table. Now, shares of Ford and GM are falling, with Stellantis slightly up this morning, or should I just say the dreaded UNCH, not doing anything. Let's get now to Bloomberg's Global Autos editor, Craig Trudell. Craig, the strike is on. What now?
I think the UAW, interestingly, is leaving itself with an option of kind of, exerting more pain on these companies. As you mentioned, we just have a handful of plants, one in Michigan, one in Ohio, and one in Missouri. And these are products that are absolutely important to these companies. We're talking about mid-sized pickups and SUVs that do quite well and make these companies lots of money. But they really didn't go for the jugular, at least yet. So we haven't seen a walkout of full-size pickup plants. And really, the union has sort of left open this possibility to not just leave it at those big truck plants, but just, broadly to strike more and more factories to sort of exert additional pressure. On the other side, you do have to keep in mind, this is a union that, if it continues with this approach of striking across all three of these companies, they only have so much of a strike fund to work with. So the companies do have, the potential here to more or less kind of call the bluff. Of course, it is not a good story for these companies, in that this is a lot of missed revenue and earnings potential if this continues to drag on.
And you look at the automakers' responses, and you see that really the fists are swinging at this point. You have a pretty strong pushback from these companies. Walk through the road ahead, given the posturing that you're seeing on both sides.
Yeah, these companies are still a long ways away from where the UAW is in terms of their demands on the simple things like wages, but also, down into the nitty-gritty things like cost of living adjustments, pensions, and a lot of things that have been given up over the last few decades, as the union really had no choice but to sort of agree to concessions to help these companies get back on their feet. The union is really sort of, out of patience with that approach, especially after the earnings of the last few years that these companies have managed. That being said, we of course know that these companies remain under pressure, whether you talk about the sort of old world competitors of the Toyotas and Hondas of the world, or Tesla. This is also a situation where these companies need to do a lot of investing in the years to come in EV and battery manufacturing, and that also comes into play as well.
Yeah, Craig, I'll tell you what, just sort of on a macro scale, I think everyone remembers those huge price spikes in used car vehicles coming out of COVID. I think we're all kind of in fear of from a macro standpoint, of that happening again. Hey, Craig, thanks for keeping us up to date on all of this. Bloomberg's Craig Trudell there on those strikes. Now, coming up, we're going to be catching up with Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity International. That'll be next. And don't miss our exclusive interview with Spain's Deputy Prime Minister of the Economy. That's coming up later in the show. Plus, Robin Dumar, managing partner at Park Square Capital, joins us to talk all things private credit later in the hour. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
What do you have for skincare for men in their 70s that have a lot of wrinkles? I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things, but maybe it'll be a little bit beyond skincare.
The Governing Council today decided to raise the three key ECB interest rates by 25 basis points. Based on our current assessment, we consider that the key ECB interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to our target.
That was the ECB President Christine Lagarde speaking at a news conference after hiking rates by 25 basis points. Let's bring in now Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity International. Salman, great to speak with you. Look, in that specific line from Christine Lagarde, that felt important, that she talked about having rates restricted for a sufficiently long duration. But this is a market that's priced in 75 basis points of cuts through 2024. Does the market have this one wrong?
Good morning. I think the transmission channel is active in Europe. It hasn't been as strong in the US, but certainly you can see the impact of rates passing through the economy. There is growth which is turning down. So the market is onto something here, which is that the ECB may not be able to hold rates at these very high levels for an extended period of time. But that said, we have to consider that we are in a narrative-driven market, and that means that if the ECB insists that they want to keep rates higher for longer, which is the message right now, then you may have volatility till those actual cuts come into play. So that's the trade-off and the balancing act we'll have to be careful about in the next few weeks and months ahead.
What is the narrative that the market is considering here in terms of how hard a landing could be? Because if they don't have the room to make those cuts to control inflation, then isn't there another problem ahead?
Yes, so that's where the differential between Europe and US has been a critical one, which is basically the US economy is still showing a lot of resilience to this very aggressive hiking cycle. Hiking cycle in Europe has been very aggressive as well, but the data is responding differently. So to your point, there can be a problem if for the central bank, if the economy nosedives in a more faster fashion, whilst at the same time the Fed is still hawkish. So the Fed does matter in this when you're thinking about the ECB as well, and that's why you have a consistent narrative from all central banks right now of a higher for longer, which may not hold.
Yeah, the long pause. Salman, in that environment where the U.S. is maybe more resilient, I know you're still underweight credit and equities. Just walk me through that call.
So our defensive call is on the back of the fact that the transmission channel is delayed, not broken. These rates which were increased and rate hikes which came through were done on planet Earth, not on planet Mars. So that they will have an impact on the economy. And we are seeing that in the UK very clearly. We've seen that in Europe. And we will eventually see that in the US as well. And the asset market pricing is not giving you those premiums, if you will, to take that kind of risk. So we are in the recession camp. We have moved that timing, but we are still in that recession time. And that's why the asset allocation looks defensive.
When you consider the upcoming FOMC decisions, do you believe what the market believes, that there could be a tapering here, an idea that we can hold for a minute before things start to get higher, given where we stand with inflationary data?
So there is this thinking that the inflation data is consistent with the pause and then of course the overall labor market data as well. But they are keeping their options open. The risk, at least from a central bank point of view, is that they may be able to hike. They may have to hike more rather than thinking about a pivot at this stage. So we are at that stage of the cycle where we are very clearly near the peak of these rates, but where we go from now really depends on visible signs of this transmission channel kicking in. And the inflation environment, there's a lot of focus on spot inflation right now, but what matters is if inflation dynamics stay where they are, because they are still above target, right? So that target hasn't achieved.
Yeah, it's that final leg of bringing things down. Hey, Salman, I'm afraid we're going to have to leave it there. Thank you so much for joining. Salman Ahmed of Fidelity International. Enjoy the rest of your weekend. All right, Miami-based 777 Partners has agreed to buy Everton Football Club. That news breaking just moments ago. We're going to have the details on that for you next. This is Bloomberg.
Next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis,
we're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Let's get you your fix of some deal news, some of the stories we've been watching. Walt Disney is said to be in talks with local broadcaster Nexstar Media Group about selling ABC Network and other TV stations. Disney said it's still considering a variety of strategic options, but has made no decision with respect to the divestiture of ABC. Now, there's more, Shonali. Bloomberg learns stand-up comic and TV producer Brian Allen is said to have submitted a $10 billion offer to acquire ABC and Disney's local stations. So some potential outcomes with this one.
Yeah, there certainly are potential outcomes. Byron Allen has certainly been active in the media space. Talks around Tegna and BET. I ran into him earlier this year at the Goldman Sachs Leveraged Finance Conference. Very clear that there is a lot of debt when you look at Allen Media, but they had already been in talks with the banks clearly about getting ready for more acquisitions. Now there's a lot more going on in media. We're also looking at that Everton deal. These sports deals are very closely tied to the media rights, and you're looking at a historic deal here for that English football club, aren't we, Danny?
That's right. 777 Partners, which is based in Miami, has agreed to buy over 94% of Everton. But it's much more tricky when it comes to English football. Let's remember, this is not a straight deal of just getting the media rights. If they get kicked out of the Premier League, they're going to be losing a lot of money. So it's a little bit more risky than an American sports team, for example, and media rights around that.
And it's interesting because I want to also talk about deals when it comes to ARM, because we want to take a look at how it's trading in pre-market. A lot of deal activity coming back to the market. It is getting that second day pop now, up around 9.6% pre-market. The valuation is around $70 billion, Danny. Now, coming up next, we're going to look at an exclusive interview with Spain's Deputy Prime Minister. Up next, this is Bloomberg.
That given that we have this productivity enhancing technology that is AI, that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working, so there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. That the big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962, at the time of the Cuban Missile Crisis. Yeah. I don't believe for a minute that we can have a Cold War II without a similar risk.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg Surveillance Early Edition, and here is what you need to know. China's economy shows more signs of stabilizing thanks to a summer travel boom and a heftier stimulus push. And Bloomberg speaks exclusively with Spain's economy minister as ECB officials fight over further rate hikes. And U.S. auto workers go on strike, setting up for a showdown over wages and job security. I'm Sonali Basak in New York with Danny Berger in London. Danny, let's take a look at the European markets this morning.
Yeah, Sonali, I was about to say, you know, this is kind of the market you think would have happened after the ECB hiked 25 basis points. But instead, yesterday, it was the polar opposite after we had that ECB hike. It was the euro weakening, and it was bonds that were bid. Now, we're getting the inverse of that today. It isn't completely undoing itself in the euro because it did move to its weakest since March. Maybe not unsurprising. We're getting some bids coming here to end the week. Duration, though, that's completely undoing yesterday's move. 10-year yields had moved lower in Germany by 5 basis points yesterday. Now they're higher by 5 basis points. Maybe those 75 basis points of cuts we've priced into the market aren't quite right if we have hawks telling the FT that there could be another hike come December. Finally, just worth pointing out, European stocks, they are up 0.7%. It's hard to see this as anything, Sonali, than China showing through. It's LVMH, it's Richemont, it's all those luxury good names, all the China-sensitive names that are really fueling this rally at the moment. We had positive China data coming out. Standard Chartered says that the peak pessimism is in when it comes to China. How about the U.S., Sonali?
China is flying through Europe and dipping into the United States. You are also watching S&P futures up ever so slightly. However, we are ending on a high note. The S&P this week is up well over 1%, and it is ending the month also on a good note if we keep up this trajectory. Now, the 2-year yield, this is where the interesting story for me is because 503 handle. Remember, we were well below 5 yesterday. We have come back up above 5. This has been flirting with 5% all week long. This is about a 2 basis point move you're seeing today. It has been moving just ever so slightly pre-market as well. We were looking at 504 a little bit earlier. Now, the Bloomberg U.S. dollar index down ever so slightly as well, off of last week's high. The dollar story has been fascinating when you look at the relative stories in interest rates around the world. That story will continue very strongly next week. Brent crude, 93, right under 94. Just a stunning move this week. We had seen it hit 90 last week. WTI also now above 90. This oil story, as we watch that economic data strength across the world, is getting pretty fascinating when you overlay that with the supply constraints, now up about 0.2% or so. I also want to take a look at another thing that's trading quite strongly. That is ARM. Pre-market, you're watching just the gains keep going. You're watching nearly a 10% move now now, pre-market at $69.76. Wednesday night, this is a stock that priced at $51 a share with doubts about valuation, now worth more than $70 billion when you look at the pre-market price. I also want to take a look at a softer story in the market. That is GM, Ford, and Stellantis. Remember, U.S. auto workers go on strike as the United Auto Workers contract falls through. You have each of these companies really coming out with statements, fighting strong, still a way away from an agreement here. You have General Motors pre-market down nearly 2%, Ford down more than 2%, Stellantis still on the rise, about 0.1%. We'll keep an eye on that, Danny, all day.
All right, from public markets, Shonali, to private. And private credit's popularity has surged in the era of higher rates. It's now a $1.5 trillion industry. But of course, higher yields also bring higher risk. UBS sees defaults surging to as much as 10% in the first half of next year, which would be more than other kinds of risky corporate debt. Joining us now is a man who knows this market very well. It is Robin Dumar, managing partner of Park Square Capital. Robin, look, we've been talking for many years now, and you've always had more of a defensive kind of tilt anyway. When we're in an environment where the ECB delivers another hike, it's already hard out there for borrowers. Does that figure sound right to you, a 10% level of defaults come next year?
I think something along those lines thematically is probably closer to right than wrong, which is a massive step up in defaults. And I think they're likely to be concentrated in some of the businesses which, as a lender, we know to avoid historically. And that is things like consumer-facing businesses, retailers, et cetera. We know there's a lot of pain coming, and I think for people who've been selective and disciplined within the credit management space, this is going to be just fine.
I feel like you know where I'm going with this, because you said lenders historically know to avoid, but have they been? Have your peers done a good job of setting themselves up for a default cycle?
I think the people who've been in business for a long time and are very experienced and disciplined are probably going to be in very good shape. We've been around for 20 years. Through the global financial crisis, we've seen a lot of ups and downs in markets, and I think we really try to focus on some core industries like healthcare, business services, software, high-margin industrials. We have literally no brick-and-mortar retail exposure in the portfolio, no chemical manufacturers, no airlines, no hospitality, no restaurants, et cetera. And I think it's that discipline within credit investing that I think is so critical. And I think the industry is going to be okay. People who are forced to diversify, people who are forced to buy the market, and I think importantly, people whose funds are so big that they have no choice but to buy the market, I think they're going to face some issues.
It's funny that you're talking about funds that are being big, surviving this market, because there's this funny little bank named Goldman Sachs that you used to work at that is not only big in credit markets, syndicated markets, but also big now in private credit as well. They join a host of banks that are trying to get bigger into private markets at a time, Robin, where people are very worried about the froth in private markets already. Do you think that there's going to be, like there had been in private equity, too much money chasing not enough good deals?
It's a very interesting question. I would say structurally, increasingly what we see is a growing need for private credit. And so I think private credit as an industry really has come of age. It's very well positioned. And banks broadly continue to lose market share. There's some exceptions. There are banking firms that have big private businesses. But in general, we see continued decline of the banks within credit markets. And that's creating an opportunity. Interestingly, though, Sonali, right now what we're seeing is a very limited supply of new transactions. And as a result, the secondary market levels, trading levels, have moved up dramatically. And I think actually it's a very good time to be cautious, particularly within the senior debt space, because there's just a limited supply of new deals, and there's a lot of capital chasing them at the moment.
It's pretty fascinating, because I appreciate your dose of reality about the default cycle. A lot of folks in the private credit market, you're talking about the safe stuff. A lot of people are ready to step up and start to finance the risky stuff as bankruptcies more broadly start to rise. What do you think about all of these people who want to step up with all this rescue financing? Do they make it out safe?
So, rescue financing, I think, is going to be one of the more interesting spaces. And I would I would probably not use the term rescue financing because I think what's going to be more interesting is providing solutions to some of these very large, well-capitalized leveraged buyouts where they simply can't service the cash interest burden of their debt. With floating rate debt and rates having moved up by almost 5%, many borrowers are going to face challenges. Now, I think that's an enormous opportunity for private credit, especially for the creative side of private credit, for example, with non-cash pay, junior securities, et cetera, to step in and solve problems. So I actually think for creative junior capital within the credit space, it's perhaps the most interesting time in the last 20 years. I think it's very exciting. There are a lot of solutions required out there.
Right. Robin Dumar, staying with us. Now, up next, we are going to go to Spain, where EU finance ministers are holding an informal meeting, and Bloomberg's Maria Tadeo is standing by with an exclusive interview. Maria.
Yes, indeed. Good morning. And we're now joined by the Spanish finance minister and deputy prime minister of Spain in this beautiful setup that we're here in what is also your home region, by the way. But beyond the setup, I do want to ask you yesterday, of course, the European Central Bank obviously hiked again. In your view, should this be it? This should be the final one.
Well, of course, I have to be absolutely respectful of the ECB decisions. Reading between the lines, I understand they have focused on two elements: level of interest rates and time. So I'm sure that they will be deciding on both in a coherent manner. I always say I hope they get it right, because it's not so easy when you have so heterogeneous inflation rates around Europe. Spain, for example, has the lowest inflation rate right now at 2.4%, but other countries are proving to be much more resistant to lowering inflation. So I hope they get it right, and from the national perspective, I also hope they stop now, because our inflation rate is already quite low.
From a national perspective, what you say is a country like Spain does not need rates going above 4%. That's basically what you say.
Well, I think that this is a good summary of.
And you said two interesting things there. You said that there's a conversation about duration and the level of it. But I wonder if there was another hike, and the market does not believe that for the time being there will be another hike, but is there now a real risk that if you were to go tighter, this is now really going to send this economy into a recession? You're suffocating the European economy.
Well, again, it varies very much between the different countries. We were just starting our Eurogroup meeting here, as you said, in Spain, in Galicia, in my region of origin. And what we see is that the situation of the different economies is very different and very heterogeneous. Again, Spain is the strongest growing economy in the EU. It is projected to be the strongest growing large economy in the Eurozone next year again. The forecast is for 2.2% GDP growth year on year this year, after very strong growth in 2021 and 22. So in the case of the Spanish economy, the prospect and the forecast is quite positive. But indeed, there are some other countries that are slowing down or even having a recession, and that has an impact overall.
And yet, as a finance minister, you also know, however, you say your projections were upgraded on that. It's very fair, but when you look at the indicators, it seems there's a loss in momentum, and there is some kind of pessimistic take on the economy now, where some say we're heading into stagflation. Is that something that you say not so fast?
Well, absolutely not. I mean, when we're talking when we're talking about 2.2 GDP growth in the case of Spain after above 5.5% last year and the previous year, I don't think that would be an accurate word, to describe the situation. We're having quite resilient growth, strong growth in our economy, and inflation has gone down by 8 percentage points in 1 year. So I'd say that would not be a good description of the Spanish economy.
And the question is whether Europe, maybe Germany, and of course the German finance minister is here, but that maybe is a separate conversation. As you say, the economies are very different. The other big story this week, of course, was the European Commission with this probe into the Chinese electric vehicles. And what they say is that China has flooded the market now with very cheap subsidies. I wonder if you agree with that step taken by the Commission. And do you wonder, in a country like this, where you're into renewables, you have wind, you have solar potentially, is there a case to say, let's also look into other areas? China may be not playing fairly, not just in the cars, but in many other areas.
Well, I think trade policy has driven growth and prosperity in Europe for decades. The EU is a world trade powerhouse. And so we have every interest to strike the right balance between ensuring a level playing field at the global level, but of course supporting international trade. The European economy has proven to be very competitive and very resilient, and we should continue to build on that basis. And I'm sure the European Commission will get it right on that front, you know. E-vehicles are a focal point of interest right now because of the technology competition which is taking place across the different superpowers at world level. But definitely we have to preserve the level playing field in all areas, particularly those that have to do with the new green and digital economy.
And then that takes me, should there be other areas where potentially you say, I'm not saying right now China's abusing this position, but there could be a case to just look at this and say, is this a level playing field? As you say, this is the biggest trading bloc in the world.
Well, again, Maria, I really wouldn't like to comment on that because I think that the European Commission has got trade policy right until now. I think they should go. I am quite convinced and quite confident that they will continue to get it right. But talking about trade policy, let me mention another highlight of these meetings. I mean, we're gathering here, it's an unprecedented event, an extraordinary setting and an extraordinary event because for the first time in history, we're gathering here EU finance ministers and Latin American and Caribbean finance ministers.
Which is exceptional.
Absolutely. For the first time in history, we want to deepen our cooperation with our friends and families on the other side of the Atlantic. And I'm sure that trade negotiations is one of the issues that will be touched upon at the corridors, maybe, no, but it's, you know, it's a key issue for all of us also.
And you mentioned Latin America, and I wonder, in this context of change in geopolitical, well, areas, of course, is there a case now where you say we need to reach out to Latin America increasingly, not just in trade, but also politically? And that takes me to the Mercosur trade deal. Is this something that you say, let's just get it done and sign this trade deal?
Well, you know, absolutely. The Spanish position on this is very clear that we should, oh yes, we support this trade deal as soon as possible, as well as the Chilean.
We have not forgotten about it. Maybe we didn't dedicate enough time as this trade relationships change across the world. But I wonder, as a future, well, maybe not a future, but I wonder, it's your future aspirations. The European Investment Bank, you want to lead it. Your colleagues here, I'm sure, have already an idea of who you are and your reputation. So you must know whether or not you're going to get this job. Are you going to get this job?
Come on, Maria. I know you fly. Until things are done, they're not done. And I am a very prudent person. So I have got very important supports, and people are extremely kind. I think I'm well appreciated and respected by all colleagues around the table.
I mean, you're working to the last minute.
I am not discussing these meetings because I'm chairing the meetings. I wouldn't think it would be appropriate for me to lobby. No, I'm not campaigning. I'm not lobbying. I am chairing the ECOFIN meeting.
This, you happen to be joining on the 15-year anniversary of Lehman. Now, in the past 15 years up to today, as we finally got into this higher rate environment, how structurally different are deals that are being put together now? How big of a sea change has there been?
You know, Danny, it's an excellent point. If I wind the clock back to the Lehman days, the typical leverage buyout had about 25% equity in a deal. It was a true bootstrap acquisition, basically. More recently, over the last couple of years, the theme that we've seen in private equity is 60% or more equity in transactions. I think we have to come up with a new name. It's not a leverage buyout anymore. It's a not that leverage buyout. But the important theme in that is, unlike in commercial real estate, where landlords or owners are handing back the keys to lenders, I think that's very unlikely to happen in large cap private equity today because the firms have so much of their own capital invested in the deals. I think they're going to work very hard to create solutions for high quality businesses, and we're certainly excited about helping them do that. I think it's going to be an interesting opportunity.
Yeah, not so leveraged buyout though. I'm afraid just isn't that catchy, Robin?
Yes.
Okay, so in that case, because one of the issues also during COVID times was the issue of cov-lite deals, of covenants that were particularly weak. Has that changed at all? If we're also talking about less keys being handed back.
So it hasn't changed dramatically. I think the last 18 months we've seen some improvements in structure, terms, and pricing. And interestingly, as a senior lender, which we are as well, we hate covenant-light deals. We just hate it. From the perspective of a junior lender, however, cov-lite's great because it means you're very unlikely to lose a company to the senior lenders. And so I think there's a longer runway associated with a lot of the liquid senior debt today. The broadly syndicated loan market is generally covenant light today, and I think it means that private equity firms have a long runway.
Speaking of runways, something that's been fascinating me, Danny had mentioned Lehman Brothers, but it's also the 25th anniversary since the collapse of LTCM. And you think about the leverage still being taken on by big multi-strat funds. We had the story we reported yesterday about Vista Equity tapping a credit line to back private equity stakes to finance a cash injection for Finastra. And you think about this rise and how comfortable people still are. And is this a signal that we've stabilized, or is this not yet firms catching up with the reality of higher rates?
Look, I think it's a little bit of both. I think that higher rates are going to be a very large headwind in general for private equity. 20 or 30 basis point move in rates is very significant, but what we've seen is a 500 basis point move in interest rates. And I think this is going to impact virtually all leverage buyouts because the vast majority of them are funded with largely floating rate debt. So I think it's a big deal. In terms of the rescue financing that we're likely to see, and you've just mentioned some names,
Today, this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Shonali Pasek in New York. All right, let's get you set up for your Friday. A look at what's ahead today. There's going to be U.S. Empire manufacturing data that will hit at 8:30 a.m. Eastern. We're also going to get industrial production. That's at 9:15. The key data today, though, is UMich consumer sentiment. That comes at 10 a.m. That has a tendency to also have the Fed rethink a thing or two. Plus, don't miss our exclusive interview with the French economy minister, Bruno Le Maire. That will be at 10:30 a.m. Eastern. Shonali.
Yeah, let's take a look at some of the stocks we're watching in pre-market trading in the United States. We have to take a look at those big three automakers, GM, Ford, Stellantis. They are falling largely as the U.S. union workers start strikes. I also want to take a quick look here at Carvana because you are watching it also come off of its highs yesterday, still up about 0.5%. But this is a stock, Danny, that took a 13% leg higher yesterday coming in to the strike deadline because the movement to used cars would be significant. Two of the big three are down about 2%. Stellantis is the only one still seeing some gain.
Yeah, there's some data out from J.D. Power. They estimated that if the strike persists for about 2 weeks, then new vehicle prices would see an increase of less than 2%. If that's new cars, though, used cars, I'm sure would have that type of even more increase, Shonali. And again, we're all living with the memory and the fear of that inflationary force during COVID.
Speaking of inflationary force, you are seeing some inflation in ARM stock because you are seeing another 9% gain in the morning today, or 7%, but gains have paired ever so slightly here. $68 a share. Remember, this priced its IPO at $51 a share. ARM is setting the stage for massive roadshows. Birkenstock filed for IPO just this week. Instacart, Klaviyo, we will watch them speaking with investors next week. Let's see if they can get the same kind of warm reception. Of course, they are very different companies, technology, but not the same type of technology, yet profitable. So some things to be watching out for.
Yeah, and you know what else to watch out for? First of all, Shonali, I want to say it's been an absolute pleasure anchoring this show with you over the past 2 weeks. I am going to miss you, but just got to give a little tease. Next week, I'm going to be launching a new show with Manus Cranny. The Bloomberg Brief will be speaking with Nouriel Roubini, the Blackstone CEO, and Seema Shah, among others. That's it.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The context around European growth has changed.
There are really across the board weakness in the euro area to a lesser or greater extent.
Recessionary risks do linger as we move into next year.
I think it's harder to see higher inflation if growth is weakening in the euro area.
I think the Fed so far has done a pretty good job. I think the ECB isn't quite there yet.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Tonight, for the first time in our history, we will strike all three of the big three at once. Strikes in America, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Your equity market just about positive on the S&P 500. TK, UAW, no deal.
Not your mother's strike, not your father's strike. When I saw it, Lisa nailed it about the 10 p.m. shock. And the basic idea here is this is an original strike going back over to UAW history, back to 1958, into some real challenges, John, before World War II. It's an original strike, a selective strike. That's what's new.
We've heard from Stellantis. They're extremely disappointed. From GM, they said they offered an unprecedented package. From Ford, the union made little movement. The elephant in the room, Bramo, we have not heard from this White House yet, have we? We're waiting for a statement from the President of the United States.
Especially because reportedly he did speak with both the union workers, the union leaders, as well as the auto manufacturers. What did he tell them at a time where his policy is contradictory? On one hand, he's pushing for electric vehicles that a lot of the workers, the rank and file of the UAW, are pushing back on, and yet they are helping some of the auto manufacturing with those. On the other hand, it's the most pro-union president in history. That's what he wants to advertise himself as.
I learned a lot yesterday from our labor experts. I know Craig Trudell's scheduled to come up with us with all of his experience of his childhood in Michigan. But to me, what's so interesting here, John, you used to go on strike against all of Chrysler, all of Studebaker. We had a Studebaker, John. And the answer is this is different. You get a map out. There's 3 states involved. There's 3 models. We'll talk about that with Craig. It's highly unusual for you, me, Lisa, and the president. This is unusual for Biden.
So, Tom, as you indicate, it's 3 plants, 12,700 workers. Let's talk about the plants that are protected. TK, the Ford F-150, the Chevy Silverado, Ram pickups. If they want to ramp this up and escalate things, there's space to do that.
Well, they can do it, but they got to spread out the strike payments. And I'm sorry, I hope we have this here. I was going to use it with Craig. Let's use it now. The Bronco, Colorado Wrangler strike. Now, my up to speed, Matt Miller's our expert here on is a Colorado cool, the GM Colorado pickup truck. I have no clue.
The Bronco's pretty cool.
The Bronco's big time cool. Like we had the CFO on sitting right here, 6 weeks ago, and he said basically they can't make them fast enough.
Well, no, they're not making them at all, Tom.
Yeah.
Based on these strikes. From New York, if you are just tuning in, let's get you some price action. Equity futures on the S&P 500, positive by 0.1%. In the bond market, the data in America, pretty decent. Yields higher again this morning by 3 basis points, 4.32 on a 10-year. At the epicenter of everything we discussed yesterday, Tom, retail sales, PPI, the ECB, the downgrades to the outlook of the airlines, this right here, $90 crude in America. Tom, WTI, positive here by a third of 1%.
You got $94.63 intraday Brent crude. Javier Blas has beat me over the head about Saudi Light extrapolating out to $100 a barrel. I'm sorry, it's moving fast, and you're dead on. It colors every conversation, including Bloom-out as GM of the Red Sox.
It colored the ECB conversation too. We'll talk about that later, Tom.
Yeah.
The euro looks like this.
The Red Sox.
106 on euro dollar. Currently 106.64, and Bramo potentially heading towards a 9th week of weakness against the US dollar.
The longest potential streak of weakness since the joint currency was created, just raising the specter of whether these higher oil prices are a good thing on the heels of better Chinese data or a bad thing in terms of disinflationary and stagflationary kinds of ideas. Today, 8:30 a.m., September Empire manufacturing data, followed by 9:15 a.m. industrial production. Messy. It's getting really messy. But if we start to see a plateauing, does it really mean anything, especially after you do see input prices increase and on the heels of the strike? It's just a messy moment. 10 a.m. adding to the mess, the University of Michigan Consumer Sentiment Survey, which both of you love and really hinge on and really try to determine the sentiment going forward. Honestly, how much does this really reflect what we're seeing with respect to higher oil prices?
The rate of change of oil prices.
Exactly.
I mean, John, I was doing that math yesterday in the blur. I can't remember the numbers from July or June. And come on, we're on the edge of moonshot.
It's always amazing how spot crude prices and where gas is right now can shape perceptions of where inflation will be later, and no doubt we might get a sense of that a little bit later.
And how much people are willing to spend. And at 10 o'clock, we do hear from the France Economy Minister, Bruno Le Maire, with Bloomberg's Maria Tadeo. But this comes as EU financial ministers meet in Spain. Christine Lagarde will be there, the EU Economy Commissioner Gentiloni, Spain Economy Minister Nadia Calvino. This is going to be awkward because they really disagree. You heard from the German finance minister. This is a good thing.
What's the outcome of this meeting, Bramo?
Well, they're going to be talking about what the region needs and what the specific countries need to foster some growth at a time of really stagflationary headwinds and a controversial rate hike yesterday among some of those officials. And so we've already heard that pushback.
Calvino already complained on Bloomberg TV in the last 20
was
minutes.
with us. I loved it. I loved when she was here. I mean, they're really living between climate change and inflation of the agricultural complex known as Spain. Spain is getting hammered.
Big time.
Yeah.
Europe, many parts of Europe, including Germany for that matter, getting hammered too.
Okay there?
That was wonderful. That's enough ECB chat. Let's get back to our top story. Strikes at the big three in Detroit. Craig Trudell joined us out of London. Craig, we've got them, all three, simultaneously at the same time. Craig, at what point did this break down? How big is the difference between GM, Stellantis, Ford, and UAW?
I think the writing, honestly, seems to have been on the wall. I think we've for weeks now known that the union and these three companies are far apart. In terms of the negotiations, I think on both sides you have complaining and sort of allegations that neither side is budging or going anywhere close to sort of the other's direction. So I wouldn't necessarily cast this as a sort of breakdown, a sudden realization that what, we're just not going to be able to do this because we haven't come anywhere close to these companies in this union being able to come to agreements on new contracts.
Auto guy, what is this? What is the imagery here, or the message from Bronco, Colorado, Wrangler? I mean, those are all cool cars for 23-year-olds, right? Is that the message?
Yeah, I think it's both. These are cool cars. These are profitable cars. These are trucks and SUVs that these companies count on for serious revenue and profit. That being said, the UAW does have some very big, sort of arrows in its quiver to sort of, use some imagery here. They do have the F-150 pickups, the Silverados, the Rams, as mentioned earlier, and just generally they have quite a few plants to add to these three facilities that they're walking out from. It's really interesting to see the companies, not know sort of what's next. The union is explicitly talking about sort of keeping these companies on their toes. And also, I think, the union is being strategic about, striking every one of these companies, but also doing it in the selective fashion means that they could draw this out and not deplete their strike fund, too quickly.
An index that the government uses is the Welch-Trudell We Run Out of Money Index. Craig Trudell, when does the union run out of strike funds?
That, of course, will depend on, just how much additional pressure they want to exert on these companies.
Give me a date. Christmas?
I mean, what we saw with GM, right, is months long a few years back. And so, I do think that this is absolutely the case that the union could drag this out for weeks, potentially months. Now, whether we see, the union be able to reach an agreement with one of the companies and go back to pattern bargaining like we've been used to it in the past. I think, the unfortunate answer is we have no idea what the union strategy is, and that is very much their intent at this point.
Craig, do you get a sense of what the line in the sand is at this point, of what will get it done?
I honestly don't have any clue of sort of what could possibly get us to a point where either side is talking about, what, we feel like we're closer. And the problem here is that there is so much going into these negotiations. We don't just have a simple issue of one side wanting a certain amount per hour and another side wanting a higher or lower wage than that. We're talking about cost of living adjustments. We're talking about representation of battery factory workers or whether or not those stay non-union. We're talking about pensions, and so there is so much that's going into these negotiations. They're so complex and multifaceted that it's really difficult to sort of, game out what is it that's going to sort of, get the union comfortable with what these companies are willing to offer.
Craig, stay close. We've got a lot to talk about. Craig Trudell there out of London on the latest. TK, where is the most pro-union president in the history of this country?
He's got to get up and he's got to get his Wheaties here this morning. But can you imagine the conversations of how to explain to this is not the strike that young Joe Biden knew, or frankly, young Tom Keene knew.
He has to come out on their side, doesn't he? He can't sit on the fence here.
That's a really important question. Very importantly, Anne Marie Horton and Joe Matthew have the former vice president of Indiana tonight. You wonder how does Mike Pence stay on the fence? I mean, does he talk to the UAW in Indianapolis here? I don't know if they're not on strike yet, but maybe they will be.
Sure.
Do these guys stay on the fence given a strike? That's
the former president. I think everyone's after the vote of this particular union.
Yeah.
Euron Timmer joins us now, Global Macro Director at Fidelity Investments. Euron, we're going to have some time together to talk about markets. Just wanted to get your thoughts on this strike, and a question we've asked continuously over the last couple of weeks, whether you view this as almost the dying embers of a hot labour market, or whether this is something we're going to see more of in years to come.
Well, good morning. And that, of course, is the big question. Has the labor versus capital pendulum swung for real? And I think there's some good reasons to think that maybe it has, because the last couple of decades, favored capital holders, right? Period of low inflation, low interest rates, of labor arbitrage around the world. Perhaps that trend is ending. And I think what we're seeing in the headlines today speaks to, the issue of whether inflation really has become a structural phenomenon or whether it was really just a passing thing that happened during COVID. And so if we're going to head to an inflation era of, let's say, 4% instead of 2%, then all the assumptions we make in the markets, and investing, as you know, is making real-time decisions with imperfect information. All those assumptions need to be questioned, including when the Fed will pivot, if it will pivot at all, whether it's even done tightening, whether the TIPS market is correct in pricing in 2.25% inflation as far as the eye can see, what that does to the term premium, and if the term premium, which is still negative, flips to positive, we could be at a 5 handle in the 10-year. So there's all kinds of snowball effects of whether we really are in a new inflation era.
You're into John's good question. The heart of the matter to me is a $63,000 GM Colorado Bison pickup. It's not what you and I lived was if the rich kids had a $9,000 57 Chevy. This is about the partition in America of the haves and the have-nots. They're building cars for what? 15% of America?
Yeah, I mean, it speaks to perhaps the end of this very, very long period of, what we call the Great Moderation. And, obviously the wealth equality or inequality is part of that same mechanism. And a lot of very smart people have written, a lot of very good reports about that. But if that trend of great moderation really is reversing, then that really changes a lot of the assumptions we make as investors. And so, including the valuation level in the S&P 500, maybe we're heading into not a bear market, but a period of valuation headwinds instead of tailwind.
True. Urian, you're going to stick with us. Fantastic to have you with us. Urian Timmer there at Fidelity Investments. TK, is this another story that just screams high for longer?
Well, higher for longer. It's going to disrupt everything, and it comes back, as Lisa was mentioning, on growth in Europe. I'm sorry, all of the babble we do about rates and that comes back to economic growth. And
every single time.
There was a headline yesterday that Lagarde wanted to ignore. And it's the same thing here. What does this strike do to our U.S. GDP?
Sarah Hunt of Alpine Saxon Words in the next hour. Urian Timmer sticking with us, and we've got to squeeze in a little bit of a conversation about a man who was stuck at Burning Man for 2 weeks. Urian Timmer was that man. Equity futures on the S&P positive here.
Should I go to Burning Man?
Good morning. No.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television. How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Wall Street is waking up. Europe is already trading. And starting Monday, Manus Cranny and Danny Berger will make sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, premiering Monday, only on Bloomberg.
Still a very tight labor market. You're not creating jobs at the pace that you were. But there's absolutely no sign of that switch being flipped and for workers to start being laid off. So I think power is still in the hand of the worker rather than the manager. I'm not worried about an organic slowdown in the US economy. There's no sign of demand falling off a cliff.
Power in the hands of the worker. Michael Showers, CEO of Marketfield Asset Management. Fantastic to catch up with him. We have strikes on the big three, limited strikes, and I think that's reflected, captured in the stock price this morning. Ford is down by 1.7%, GM is down by 1.5%, Stellantis is actually positive.
It's un-American. Come on, it's Chrysler.
TK, 12,700 workers across the three plants. For now, it's limited. This is about how long it goes on for and whether it spreads.
Now we're going to learn about this. I mean, limited till when? Friday? Next week?
Don't know.
We don't know. We're making it up as we go. The way I feel sensitive about this, John, and I mean, I guess we got to do data here, but, I believe in community, art, self-expression.
Where are you taking this?
I just, the mail's coming in. Someone named Anne Marie in Washington emails in and goes, "What would you wear at Burning Man?"
At Burning Man. Okay.
I wear what I wear. I wear this everywhere. So I took three.
You wear a bow tie.
I took 3 suitcases once to Asia. Never again. This is the uniform.
Just a bow tie. Or other clothes around.
Oh no, I'd wear this. Maybe I'd
just trying to figure this out. Bramo, just trying to figure it out. Just want to know.
What's the appropriate, Lisa? What's the appropriate mud boot? There's got to be like a Farmall Great All mud boot or whatever.
You think that I've been to Burning Man? I don't know. I normally wouldn't need a mud boot.
You say Burning Man. I can see Bramo there.
Bramo at Burning Man.
Would you like?
I can now see you at Burning Man.
Actually, you'd be your own arts installation.
I think that would be very cool.
Community art.
You'd just welcome and everyone would gather around the campfire and Tom would tell you stories.
Yeah.
Perfect. You can talk to Urian about
Bring
it.
in Urian here.
Urian Timmer, do you think Tom would fit in at Burning Man? Does that work for you?
He knows how to cook. He fits into our camp any day.
Do you know how to cook, TK?
No. I know how to boil water.
Urian,
sit
tight. I've got to whip through some price action just briefly. In the equity market on the S&P 500, we're shaping up as follows on the S&P futures, just about positive by 0.1%. I want to look at the euro. Positive here by 0.2% to 106.66. For the euro right now, what a tough position. The ECB didn't want to commit to a pause, but it certainly sounded like a pause. The complaints that they're getting so far this morning, we already talked about the pushback from Spain to Maria Tadeo moments ago on Bloomberg TV. This from Matteo Salvini, the Italian Deputy Prime Minister, had this to say. The ECB, which doesn't care about the economic difficulties of families and businesses, is increasing the cost of money. Lagarde is living on Mars. Is the message coming out of Italy, Tom? A certain part of Italy this morning.
Well, this is the divide of Italy, and it's like the 50 states of America, but every lesson we've learned is it is not the 50 states of America, and the fractious Europeans each have their original story. The key single word I saw yesterday, going back to Trichet, is the word transmission. These dynamics transmit through the American economic experiment way different than they do through Europe.
They transmit through the banking system in
big
Europe
difference,
in a much
big
more
difference.
pronounced way. Urian Timmer's with us, Global Macro Director of Fidelity Investments. Urian, can we get a flavour for the Federal Reserve next week from the ECB, or is the ECB just its own beast on its own planet, perhaps, as Matteo Salvini pointed out, perhaps on Mars?
I think the Fed will do what we all expect it to do, which is to pause and basically indicate they're data dependent, and the question is, when will it pivot, if ever? The market has been consistently incorrect in expecting an imminent pivot, and the market can be forgiven for that because history shows that when the Fed stops tightening, it usually starts easing very quickly after that. So maybe the forward curve, the SOFR curve, is just a math project based on history. But the big question is the stock market has been playing the soft landing scenario, and that certainly is panning out in terms of the economy. Earnings looks like it has bottomed in the second quarter, but part of that scenario was an imminent pivot back towards a 3 handle. And I think the news that we're seeing about the strikes, inflation in general, core PCE remaining pretty sticky above 4%, and what we saw in the ECB is that the higher for longer narrative is going to persist, even if the Fed is indeed done tightening rates. And that is something that the market really isn't priced for.
Well, let's talk about the price of energy. $90 crude. Does that disrupt the soft landing hopes and dreams?
It could. I mean, obviously, American consumers are spending less on energy than they used to, a few decades ago, and certainly on the core inflation measures, it's going to have a limited impact. But the base effects of the inflation data from the last few years, of course, that ran out a few months ago. So we have likely seen the most of the improvement. And I think the fact that core PCE, super core PCE, all remain at a 4 handle, even though the TIPS market is pretty steadfast on predicting 2.25 as far as the eye can see, I think is definitely a disconnect between the market and the reality. And it's certainly one of the assumptions assumptions that I think we all need to look at because it will reverberate to many other aspects, right? I mean, R star at 1%, you add inflation, it tells you neutral policy is maybe 3.5. Well, maybe neutral is 5 instead of 3.5, in which case the Fed isn't even that restrictive yet. So there's a lot of, there's a snowball, a chain reaction there once you start questioning the assumptions that we have in the market today.
So you're not buying, Yuri, in this idea that we've reached the end of rate hikes, both in the ECB and the Fed, like many people think?
Well, I think we may very well be at the end of rate hikes. But again, the question is, how restrictive is the Fed, right? So if you look at the TIPS market and the Fed's at 5.25 to 5.5, the Fed is at plus 300 basis points versus inflation, which is very restrictive, right? And if you look at R star 1.25%, you add 2.5% inflation, the Fed is restrictive. But again, these are all assumptions, and that's one of the challenges that we have is that we're all making investment decisions based on assumptions about whether a certain regime will persist or whether it will reverse, and it really does all come down to inflation. And when we look around us, to me, it looks like it's going to be a lot harder to get from 4 to 2 than it did from 9 to 4.
So, Yuri, final thoughts on what we should do as investors: park in cash, hide, take my 5% yield. Yuri, what should I do?
I think this is becoming a more tactical market, which I hate to say because I tend to not believe in tactical trading. I'm more of a long-term person. I do think, some variation of the 60-40, whether it includes cash or tips, remains a good idea. I mean, in the bond market, for instance, you're getting 4.3%. If we go to 3%, that's a 10% return. If we go from 4 to 5%, that's only like a 1% negative return. So the risk reward in the bond market, even if bond yields have not finished rising yet, remains pretty compelling in a 60-40 portfolio. So I'm still there. I'm still constructive. But when I look at all the factors that we're discussing, and I look at where we are kind of in the secular bull market, my guess is that maybe we're in the twilight phase of that secular bull, and we're going to start seeing valuation headwinds instead of tailwinds. And again, that doesn't mean the market goes down. It just means that price action has to be completely carried by earnings rather than PE expansion.
Yuri, always thoughtful. Thank you, sir. Yuri Timmer there at Fidelity Investments. A ton of multiple expansion through the year so far. These yields just aren't going anywhere, based on what we've seen over the last month. The 2-year still in and around 5%. The 10-year still at about 4.32. Had a lot of people lining up to say this move, Tom, was unsustainable. And here we are, another month, staring down the barrel of the same numbers on a 2-year, on a 10-year, on a 30-year.
Except there are singular statistics that agree with that, like Swiss franc, Euro Swissie really hasn't moved, doesn't indicate fear out there. And I got a single bullet, 93.94 on Brent crude. That's moving.
That's a big change.
I don't know how that changes the debate here, other than in a slower growth environment, that helps.
It can change, of course, but Lisa, the 30-year is back in the 440s this morning.
The change has been that the U.S. economy has withstood some of these higher energy prices and seems to keep chugging along.
Let's see if that can keep happening. Based on what we saw yesterday in retail sales, pretty decent, supported by what's happening with gas prices. You want to talk Formula One? I know you do. I can see it on your screen. Got to wait, Tom. Neil Shearing of Capital Economics.
They drive at
night. Coming up from New York. This is Bloomberg.
best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
What do you have for skincare for men in their 70s that have a lot of wrinkles? I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things, but maybe it'll be a little bit beyond skincare.
Elon Musk and Tesla must be feeling good this morning. TK, the competition from them. You've got the big three trying to make this big EV transition. Union workers going on strike.
$94 a barrel.
They're in a good spot right now. Equity futures on the S&P 500 positive by 0.1%. A little bit of a lift here on the NASDAQ. A little bit of a move lower. We're down by 0.1% on the NASDAQ. Still heading towards a week of gains on both the S&P 500 and on the NASDAQ as well. Small caps had a really nice day yesterday off the back of the data in America. The Russell up again this morning, Tom, by 0.1%.
It's very acute of you to bring that up because it was a massive short cover in small caps. And this goes to my questions of the week, folks, of what is the bet on the market? I get too many people telling me the bet is up, the bet is complacency, and I don't buy it. I think there's a lot of people out there betting the gloom. And yesterday they went, okay, there was a lot of gloom there. Dow up 300 points.
Right now, the reality is resilience. You see that in stocks, and you see it in the bond market too. Just still in and around 5% on a two-year. Two-year right now, but another 3 basis points to 5.04%. On a 10-year, 432, up 3 basis points there. And in the 440s again on a 30-year yield, up 3 basis points, 441.43. The good stuff happening in America. The more difficult stuff happening in Europe, and that means one thing. The euro's weaker, the dollar's stronger. Euro-dollar heading towards a 9th consecutive week of dollar strength and euro weakness, 106.63. The toxic mix this morning, Lisa, you know it well. It's 94 Brent. It's a weaker euro. That's a problem for Lagarde, who's talking up a sluggish economy.
Which is the reason why she's getting a lot of pushback. So now she's got to deal with the political blowback from other finance ministers in the region. And you understand how Europe is not the U.S. when it comes to lots of different states. It is a different picture in Europe. And this, to me, is the question. Is this really about the U.S. withstanding higher oil prices in a much stronger position than what we're seeing in Europe?
Without a doubt. But could you imagine how much worse it would be if we didn't have almost record output in America, Tom, for crude?
Well, this is our
close to
non-energy
13
policy.
million barrels a day in America.
It's not said enough. I mean, there's, the whole political thing, and maybe, Anne-Marie and Joe will talk to Vice President Pence about this tonight, about the Strategic Petroleum Reserve and all that. But yeah, you're right. There's been a successful energy policy in America, based on technology.
Despite this government or because of this government?
Come on,
maybe.
Don't. That's a question for Bramo, not me.
Maybe despite. We'll catch up with Anne-Marie a little bit later this morning. Under surveillance this morning, the United Auto Workers striking at each of Detroit's big three car makers after the deadline for a new labor deal passed overnight. The strike hitting plants in Michigan, Missouri, Ohio, with the UAW looking to cut production of profitable vehicles while minimizing the impact on their strike fund. Lisa, we've talked a lot about the logistics involved here. the strategy involved here on behalf of UAW to keep this a surprise, and ultimately also to make sure they've got something in their back pocket if they want to escalate things.
At the same time, you have to wonder whether this prolongs things or whether this is basically pushing out the deadline in a bit. You know, in other words, if you weaken the ramifications of the strike at the outset, does that mean that you're basically saying the deadline is maybe the next time we ratchet it up? Or are you saying that we're hunkering down for an $825 million strike fund to make sure it lasts as long as possible with each of the members receiving $500 a week?
F-150s, you'd have to imagine, is like the last chess piece to move. F-150s.
Honestly, to me, I was looking at the list of things, and it's basically what's cool and what's not, right? I mean, it's sort of like the cars are going after, like, they're profitable, but they're not like the F-150, and they're not like the Silverado, and they're not like the Ram pickup, and you have to wonder if they're basically picking
does
this
that
up.
say what Detroit and Dearborn have really become, which is purveyors of $80,000 pickup trucks?
Yes.
Is that really what it says?
Yeah, and leaning harder into that direction.
Exactly.
Tom.
Yeah, man, I remember my first CEO interview at Bloomberg was with the wonderful Rick Wagoner, economics, Duke University, and it was just real simple. He said we'd given up building small cars. It's just that simple.
Yep,
and that's where Joe Biden is in this strike.
A ton more on this, and maybe we'll hear from Joe Biden, the president, out of the White House a little bit later this morning. Let's talk about the ECB. Governing Council member Mattis Muller seeing further rate increases as unlikely after the central bank raised interest rates for a 10th straight meeting yesterday. Muller writing, quote, "To the best of our knowledge, no further interest rate hikes are expected in the coming months. Interest rates have already reached high enough to be expected to bring inflation back to close to 2% in the Eurozone over the next 2 years. That comes as the FT reports that more hawkish policymakers at the ECB could push for another rate increase in December if wages keep rising and inflation proves stickier than expected. It's pretty obvious right now. There is a split at the ECB. President Lagarde talked about it in the meeting yesterday in the news conference. One thing we didn't talk about yesterday, everything that was going on. In the mix of all of that, Betty talked about there was a rate cut in China. Some good news for China's economy overnight, with industrial production and retail sales growth jumping almost 5% last month from a year prior on the back of recent government measures to spur more household spending. Weakness in the property market remains. Property investment slid 8.8% in the period from January to August. Bramo, we had retail sales, downgrades to airline outlooks, the ECB, take your pick. What we didn't talk about was China and the fact they're still easing.
Which to me is, okay, a good thing. Some of this was expected. The fact that Chinese home prices dropped more than before they started stimulus isn't exactly auspicious. And some of the investment was also down. My question is, for Europe, we're not seeing the necessary, we are seeing a little bit of a boost in the euro. Maybe it's on the heels of some of this data. But does this bolster oil prices more than it bolsters the outlook of Europe?
That goes back
I mean,
to
is this
the
sort of
demand
the push-pull? Yeah.
You've been great on this, talking about the demand microeconomics of oil. And, you know, next week, Christian Malek scheduled to join us from JP Morgan.
That's going to be cool.
That's the oil discussion next week.
Out of London next week. TK, President Lagarde talked about this in the news conference. Just stuck in the worst of places right now. She had to talk about China. She had to talk about energy prices. They've got to talk about a weaker growth profile, the prospect of higher inflation sticking around for longer. Tom, for all the wrong reasons, they had to hike interest rates yesterday.
You know, Michael Spence, there's a book out right now. Alarian and Mike Spence is involved.
Permacrisis.
Yeah, this
Brown,
is
Spence, Alarian.
This is Michael Spence territory, folks, talking about the convergence of everything that's going on and what it means for growth that we live and try to live each day. For a brief on this right now, Neil Shearing joins as chief economist at Capital Economics. Let me get the Excel spreadsheet out of the way, Neil Shearing. Did you adjust your spreadsheet off of Lagarde yesterday?
No, we didn't. We've been saying since actually March of this year, we thought the ECB rates were going to 4%. It looks like we've got to 4%. It looks like this is the peak. Big question, of course, is how quickly they come back down from there. I don't think that's a story to right to the back end of next year. Really.
I mean, the arch of economics here is tangible. Michael Spence and I had the privilege once of talking, my great privilege to talk to Professor Spence about, he was a student of John Hicks, which is, folks, that arches back over 80 years of economics, even 100 years, some early Hicksian economics out to Michael Spence now. The fact of the matter is everybody likes to talk finance, interest rates, and the rest, but it redounds back to the IS curve and the real economy. What did you learn yesterday about a fractious ECB and how they will address a growth slowdown?
Well, you're right. You alluded to it earlier in your discussion that the ECB is stuck between a rock and a hard place. On the one hand, it's got inflation that's coming down, but it's coming down more slowly than it would like. It's got oil prices now. It's having to contend with $90 plus on the oil price, and of course, Europe being a big net energy importer, European natural gas prices also up. On the other hand, the economy is really struggling, not just the Eurozone economy as a whole, that's doing kind of muddling through, but the German economy is really in the doldrums and manufacturing in particular. So weighing these two things up is incredibly difficult for European policymakers right now. I think the judgment is that their judgment will be that they've probably done enough when you consider the lagged effects of monetary policy. That's the other unknown here. But really, they're in the dark.
Which raises a question of whether the end of rate hikes is actually a positive for the economy or negative. We almost saw a sigh of relief yesterday when people got more comfortable with the idea that maybe central banks are done and we're entering the period of the great pause. Is that a bullish thing right now, given everything that you just said, particularly with Germany?
Well, on the face of it, it could be a bullish pause. It could be bullish for the markets. But I think the flip side of that is that the reason I suspect central banks are now pausing, the Bank of England has probably still got one more hike to come next week, but most central banks are, I think, probably done hiking now. We've yet to see the full effects of the previous tightening come through into the real economy. And I think we'll start to get more evidence of that over the next 3 to 6 months. And of course, as the economy weakens, that means corporate earnings are going to weaken. That will feed through to the equity market. So could be a bullish story for 2024, the back end of 2024, once inflation's a bit more under control, central banks are starting to unwind some of that tightening, cutting rates. Second half of next year, I would think looks pretty good for the equity market, but we've got a challenging few months to get through before we get there.
So a snarky commentator who watches the show sent me this message. The U.S. innovates, China imitates, and Europe regulates. And there has been this concern that the regulation and the sort of late to the game sort of, questioning and jawboning of Europe is going to leave it behind in all the technological advances that people say will get us out of whatever muddle we are in. What's your view on that? I mean, is Europe going to be permanently left behind as a result of hemming and hawing and not really having conviction behind some of the latest technology?
Well, good question. I think the first point to make is that we've done a lot of work at Capital Economics. We're about to release a major report on this. We think AI is and should be considered to be a general purpose technology. That's important because those GPTs are transformative in terms of productivity growth and economic growth. Second point is that the US is undoubtedly leading the way and will continue to lead the way, not just in the innovation, but importantly, diffusing that through the economy. So it's not just innovating the technology, building it, you've got to get it out into the economy. The US on every metric is leading the way on that. But I don't think it's so simple as saying the US innovates, China's somewhere in the middle and Europe's well behind. Actually, China's doing a lot of the innovation, but the diffusion of this technology, and in particular, the ability of its economy to adapt to some of the challenges, is much more limited than the US. So I think it's an area where the US is going to lead Europe, but it's also going to lead China.
And Neil Sharing, the day that Capital Economics first published, it was about trenchant thought pieces, trenchant notes that you were like, damn, I've got to read this. Where are we a year from now? Give me the Capital Economics note you're going to write year end about where we're going to be 3 and 4 quarters out. Do you just assume diminished nominal GDP globally?
I think what's happening is that the next 6 months is going to be pretty challenging for the global economy. China is not a cyclical downturn, that deflationary bust, but it's much weaker structural growth, and I think that's something the global economy is going to get used to. I think the US is going to flirt with recession over the next 6 months or so. Europe, if it's not already in recession, I think will probably fall into a mild recession. So we'll go through this cyclical downturn. Then the question is, what does the next regime look like? How rigorous is the recovery? And I suspect that once we get some of these new technologies through AI, I suspect some of the kind of medium-term bearishness over economic growth and productivity, particularly in the US, but also perhaps in Europe, is a bit overdone. China has its own structural problems, but I can see a future where economic growth in the medium term is a bit better than the consensus expects.
A better future, Neil. We welcome that. Neil Shearing of Capital Economics with a better tone. going into the weekend. How about this? Triple-digit crude is already here. Javier Blas of Bloomberg Opinion joining us next on this program. Here's the lead paragraph in his column this morning. In the world of crude, there is no such thing as the price. There are dozens of different measures, one for each variety of crude. The financial market focuses on two, Brent and West Texas Intermediate. They suggest a price hovering around 90. It's what we see on the screens right now. But from the perspective of Saudi Arabia, oil is already touching $100 a barrel. TK, that conversation up next.
I made a chart years ago. It was picked up by the FT. It was used by the IMF, and it's off the series Javier is talking about, which is Saudi Light. I call it the Daniel Yergin chart because it goes back to his magisterial, the prize. It is oil back to the time of Nixon and before Nixon, not 1938 when the Americans showed up to discover oil for the Saudis, for the Saud family, but it's the important series. This is Javier Blas, the pro, and he's looking at the pro series.
It's deeply, deeply thoughtful stuff, Bramo, and the politics of it, absolutely fascinating. Ultimately, the Saudi Arabia is allowed to charge a premium for its crude because the Europeans have to back away from the crude supplied by Russia, and here we are, triple-digit crude out of Riyadh.
Yeah, and India, I'm sure, is importing all the cheap oil from Russia and then refining it. This is sort of the moment we're in where Europe just keep taking the hits. I mean, my goodness.
Big time. It's getting more and more painful. Brent crude, 94. WTI, $90 and about 50 cents. Javier Blas of Bloomberg Opinion on the commodity market coming up next. From New York City, this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
The Saudis have always been very cautious about avoiding demand destruction episodes. And certainly, I think they will become cautious again if prices break through $100 a barrel, because as we saw last year with gas, with natural gas, if prices do get out of whack, you can lose a lot of demand. So you have to be careful what you wish for. If prices move up too fast, you can end up hurting consumption.
They're moving up very fast. That was Francisco Blanch, the head of global commodities and derivatives research over at Bank of America, joining us a little bit earlier this week. $94 Brent. WTI right now through 90. Highs we haven't seen for the whole of this year. A new high for 2023 on WTI, $90 and about 60 cents. Up on the session by about 0.5%. It's EK. Crude getting closer and closer to triple digits. But according to Javier Blas in Riyadh, We're already there.
Long ago, Stuart Wallace helped build this out. Bloomberg Hydrocarbons, and the leadership has been Javier Blas, writing for Bloomberg Opinion, and of course the book award-winning The World for Sale. Mr. Blas joins us this morning. Javier, I want to get away from market economics, and I want to talk about the culture and fabric that you wrote about in The World for Sale. If you interpolate out $100 Saudi Light, what does it do to the royal family? What does it do to the fabric and culture of Saudi Arabia?
Well, what it does for the royal families, they immediately became very popular. You saw it on the G20 a few days ago in India, where President Biden was again shaking hands with Mohammed bin Salman, the Crown Prince of Saudi Arabia. And using the own words of the president, of the US president, he wanted to make of Mohammed bin Salman a pariah in international economics. And now he's shaking hands. $100 that just transforms the Saudi royal family into a mass need. It's someone that everyone needs to talk, everyone needs to debate, because $100 oil is going to have profound economic implications just when central banks are trying to decide that whether they have done enough for inflation.
Javier, President Biden is going to speak of an auto strike today. He and I remember when there were a lot of VW Rabbit diesels sold in America, and Detroit was hammered. And then 1986 happened, and OPEC was broken. The price plunged. Is there any ability to break OPEC Plus, to break the Saudis in 2024?
No, I don't think so. I think that OPEC and OPEC Plus, particularly this joint agreement between the Russians and the Saudis, is still very strong.